Welcome back, y'all. No technical difficulties. I think I might have been doing too much at once. I know, not me, right? Yeah, I know. Welcome back. Welcome back. Spent all that time waiting for people to get back just to knock them all offline again. That's funny. Welcome back, y'all. Come on in. Issa. I'm just glad it happened now instead of when I was like halfway through my presentation. It's going to be a lengthy one. It's also going to be what we cover in class tomorrow. So there's no reason for you guys to double dip it, but I just need to get it off my chest, off my conscience, and it's already been said. And we'll be good. Nice, perfect. The reason I'm doing it like this is because I realized I really should have. This should have probably been chapter 2. What is money? Why is money? What is Bitcoin? Why Bitcoin? But you just forget after doing this for a while that um, some things aren't obvious. I mean, perps you would just be on um, perpetual chart, right? It's where CME closes on perpetual, and your future is on your CME one exclamation, your futures chart. What is Solidus? It's true. If we don't all agree, and it definitely loses it. So the way we're gonna run it, we're gonna do 1, 2. All right, we're gonna do 3 short clips, 5 to like 8-minute videos, and then we're gonna listen to the podcast and then go into the rest of it. Get rid of these logos for now. It's at the beginning too, so people will be able to just rewind to the beginning of the stream and rewatch. We don't have to wait for everybody to get in here. You guys have been waiting long enough. Bitcoin still looks stable, value area low. Not really missing out on anything here. All right, cool. Give me a second. That's the thing here. All right, is that better? Mic check, 1 2 1 2. Give me a second, YouTube. Trying to get Discord sorted out. I think everybody might be asleep though. All right, I can see it moving now. It works. All right, so Clarity Act, right? A lot of confusion about what it means, about what it means for money coming in, about what it means for the future of banks. So I was just gonna dive right into sort of like what it means for banks, but it's kind of an important topic. So I figure if any, we should start from the beginning on this. And like I said, it should have been included in Cypher School. So consider this one a freebie. So first we'll start with a basic what is money, right? Majority probably know this, or at least most of this.
Welcome to the Magic Trick in Your Pocket, where we uncover the secret of how banks create money out of thin air and why this system actually works. The biggest secret in the economy is that money is not just a limited pile of physical stuff. In reality, money is mostly digital records of promises. When someone makes a promise to pay, or a debt, new money is born. This concept started in 17th century London with the goldsmiths. People initially deposited physical gold and received 100% backed paper receipts. The great discovery was realizing they could issue more receipts than the gold they held, leading to fractional banking. The old textbook myth, known as the, quote, multiplier model, suggests banks must wait for a deposit before they can lend money out, relying on reserve requirements. The modern reality is that loans create deposits. Banks don't wait for your money. The process begins with the borrower's promise, followed by the bank typing the new deposit on a keyboard, thus creating new money. This is the IOU scale. When a new loan is made, new money is created. When the debt is repaid, the money is destroyed. The total money supply is the difference between new loans made and old loans paid off. Money exists in layers. Red tokens paid, the money. New loan is made, new money is created. When the debt is repaid, the money is destroyed. The total money supply is the difference between new loans made and old loans paid off. The total money supply is the difference between new loans made.
This is what money is.
The total money supply is the difference between new loans
really
made
plain and simple.
And old loans paid off. Money exists in layers. Red tokens, M0, are reserves and cash created by the central bank. Green tokens, M1, are checking accounts created by commercial banks for daily spending. Blue tokens, M2, are savings, stored for the future. The central bank acts as the thermostat for the economy. It changes the interest rate to influence borrowing. High interest rates mean fewer loans and less money, while low rates encourage more borrowing and more money creation. The era of the 10% reserve rule ended. Today, U.S. banks have a 0% reserve requirement. The system is now flooded with ample reserves. Completely 10% reserve rule ended. Today, U.S. banks have a 0% reserve requirement. Percent reserve rule ended. Today, U.S. banks have a 0% reserve requirement.
That means that every single dollar that comes into the bank can be loaned out to somebody else. When somebody tells you that your money's not sitting in the bank, it literally is not sitting in the bank. The second your deposit goes in, that gets loaned out to somebody else. The debt from that loan that the other person receives just increase the money supply. Right? That debt becomes the new money printed. Now at 0%, it used to be 9 out of 10. It used to be 8 out of 10. Before that was 7 out of 10. If you put $10 in, they could use 7 for loans. Then it went 8 for loans. Then it went 9 for loans. Now it's all of it.
The system is now flooded with ample reserves, completely changing how banks operate. Banks must adhere to 2 rules for survival: liquidity for short-term survival, defending against bank runs with liquid assets, and solvency for long-term health, defending against bad loans with bank capital or the owner's money. Capital requirements ensure banks have, quote, skin in the game. If a bank makes riskier loans using depositors' money, regulators require the bank's owners to increase their capital contribution to absorb potential losses. The underground plumbing shows how banks pay each other. While 97% of money is commercial or green, when banks transact, they must use central bank reserves or red tokens via systems like Fedwire or chips. The future ledger involves possibilities like wholesale tokens for banks, using blockchain for instant 24/7 payment plumbing, and retail CBDCs, which would allow the public to hold red tokens, potentially changing the whole system. In this model of the economy, the central bank sets the price via interest rates. The borrower makes the promise, the commercial bank creates the loan, and the regulator checks the foundation for stability. The magic word is trust. The core engine of the modern world is providing immediate cash based on the statistical trust that the debt will be repaid tomorrow. The ledgers and rules may evolve, but trust remains fundamental.
Which is what Solidius was talking about earlier when he said it's a shared fiction, right? Because there isn't enough money to pay off every debt, right? There's more debt than money, which means to keep the system from falling apart, they need to keep printing, right? The red tokens that they were talking about. This is the money that ends up in our pockets, right? The red tokens. These are created by the central bank. The central bank releases fiat. It takes about 100 days to get into our pockets, right? The green tokens are the checking accounts, right? These are used by commercial banks. This is how they spent out. This money never comes into our pockets for the most part. It goes into your employer's pockets. Maybe it goes, trickles down, but, and then your M2, right? The global M2 that we follow, the big liquidity gear, right? This is the part that is unstoppable. To keep M2 from completely breaking down, that wheel needs to keep turning. So the problem is right now, banks are using cash to pay each other, right? To move money around. And the problem with that is that the inability to move money quickly, right, costs them time and costs them money. So what they've been trying to do is find their way into the blue tokens or the green, right? They want to be able to transact faster without being on the regular rails, which is how we get to the Clarity Act. The problem is that this opens up a real threat for them, because the way that banking operates, it depends on deposits, like we just talked about. So now that you understand that deposits become debt and debt becomes new capital, right, that's printed out by M2, that goes back in people's pockets, that qualifies them for more debt, right? It goes back into the bank, that creates more loans. Now we'll get into the second part.
Welcome to this video on the erosion of the fractional reserve system. We will explore how yield-bearing stablecoins threaten the traditional banking machine. The global financial architecture is undergoing a structural transition. Banks have long monopolized deposits, but today, narrow bank digital assets backed one-to-one by treasuries are challenging this model. Traditional banks rely on the net interest margin engine, capturing cheap capital from deposits that pay near zero interest and lending those funds out at a premium. The fractional reserve system, known as the multiplier press, allows banks to hold only a fraction of deposits on hand, essentially creating money and funding economic growth. Banks also profit from the settlement lag, the multi-day delay, during which they earn interest on the capital. Instant digital settlement, however, eliminates this, quote, float revenue. The arrival of automated digital yield offers a rational alternative to stagnant savings. Yield-bearing stablecoins provide returns from high-quality liquid assets, such as U.S. Treasuries. Traditional banks and stablecoins represent two fundamentally different architectures. Stablecoins act as narrow banks, holding one-to-one liquid reserves without multiplying money or issuing risky loans. Mathematical competition overrides habitual loyalty. As payment instruments start bearing high yield, consumers rationally move their savings, draining the foundational deposit base of banks. The degradation of deposit composition occurs when stablecoin issuers redeposit retail money. It transforms safe, granular retail deposits into massive, highly volatile wholesale reserves. The intraday liquidity shock results from stablecoin-driven payments acting as continuous liquidity shocks to banks. This forces banks to hoard cash, reducing lending to the real economy. If deposits shift to stablecoins backed by U.S. Treasuries, bank depositors become funders of government debt instead of supporting private economic growth, projecting a $1.5 trillion loss in lending capacity. Regulatory actions like the Genius Act attempt to create a legislative shield by explicitly forbidding permitted stablecoin issuers from paying yield, aiming to prevent mass deposit flight. However, yield finds a way through the back door. Crypto market routes like DeFi protocols and intermediaries offer economically equivalent yield to users, frustrating regulators. The empire strikes back with tokenized deposits. Banks develop these to bring their fractional reserve liabilities onto the blockchain, retaining FDIC insurance and the power to multiply money. The battle lines are drawn for the restructuring of global money. Traditional banks must innovate their fractional reserve models or face the evaporation of their deposit base into automated, narrow-backed yield protocols.
So the issue with banks, and that'll be the last time you ever hear music on an infographic. I just forgot to delete it. I apologize.
Thank you.
Cringe factor was super high. But so the issue is that there's a couple of ways that banks make money with deposits, right? It's not just them being able to fund the loans, but it's also the delay, right? Banks make money on how long it takes for money. Banks make money on how long it takes for money to move through the system, right? They rely on capturing that cheap capital because they have the monopoly on safe transactions, right? They can charge whatever they want. They can take as long as they want because how else are you going to send money from A to B? Now we know, right? Because we use DeFi and we use other mechanisms. But that delay, right, is a real sort of moneymaker for banks. The problem is that with instant settlement and zero float, right, that takes one revenue source away from them. Now, their second revenue source is yield from holding from holding your deposits. The problem is we're getting digital yield at a higher rate on DeFi from stables, right? So now they have challenged to that deposit monopoly that they had, right? When you got a bunch of money, when that liquidity wheel turned and everybody started getting cash rich, you automatically ran to the bank and put your money in the bank, right? So turning that liquidity wheel always brought the money back into the banks. The problem for them is if you're getting 10% or even 5% for sitting it in USDC or USDT, that they're going to now start providing, right? So same bank, same building, same account, you're just holding it in stables instead of money. It cuts them off completely because they can't take your stables and they can't loan out stables on your deposits. They can't fractionalize crypto like they can with fiat, at least not yet, knock on wood. They're going to try, trust me. So for them, they didn't want this clarity bill to pass because the clarity bill obviously opens the door wide open for stables. But if they open the door for stables without handling this yield issue, then people will just drain their deposits. Just doesn't make any sense, right? The bank's telling you, hey, here's your, you can use stables now, and they have to offer stables because if the Clarity Act goes through, they're just going to, again, lose, transactions and lose business to somebody else. Then they have to try to lock it down. And apparently, from what I've seen, they've been pretty successful at it. I don't hear many good things coming out of the Clarity camp as far as us getting stables. I mean, as far as us getting yield on stables, which, kind of sucks. Think about it. But they've managed to make money off of, the way things run, and they're going to fight to keep it that way. And if it changes, then they'll figure out a way to do it. This is their excuse, right? The excuse that they're giving inside of the Clarity Act meetings is, look, we will take the risk to support everyday people, right? But if you force us to hold bonds and give yield on bonds or provide yield on bonds, on stables, and stables are backed by bonds, then you're basically turning us into holders of government debt. But it's all bullshit. The real honest story is that they don't want you to have another option. DeFi gives us that, right? Even if the stable bill, even if the Genius Act stays as it is and we can't legally get yield on stables, exchanges will find a way around it, right? Like Binance is already talking about giving, I can't remember what the percentage was, like 4 or 5% return on stables, but in Bitcoin instead of stables, right? So there's a way to get around it. You know what I mean? Or, in a BNB token or whatever. They'll find a way to they'll find a way to get you to give them your stables so that they can hold them for, liquidity purposes. And they'll find a way to pay you whether the government is okay with it or not, honestly. So now let's get into the actual bill. And then we're going to listen to the clankers, chop it up so we can break up the monotony a little bit. And then we'll get into how I plan on dealing with it investment-wise.
Look at this global map. These glowing lines represent the legacy financial rails of the US dollar, the SWIFT system and petrodollar wires that have routed global trade for decades. But notice what happens around adversarial nations. The lines fracture. Countries are building parallel networks to bypass traditional dollar sanctions. The infrastructure that guaranteed American financial dominance is losing its absolute monopoly. Transactions for energy and goods are increasingly settling outside the immediate reach of the New York banking hub. To counter this, the legislative text of the Clarity and Genius Acts addresses a geopolitical objective. They function as architectural blueprints to integrate the dollar into the blockchain and preserve its role as the global medium of exchange. This transition addresses a specific vulnerability. As adversarial states attempt to settle commodity trades in local currencies to avoid U.S. oversight, the Treasury is responding with a federally regulated digital alternative. The United States is moving the mechanism of its global influence from the physical flow of oil to the programmable flow of the stablecoin dollar. By digitizing the reserve currency, the government can maintain jurisdiction even when physical trade moves through non-Western ports. To understand how this geopolitical weapon operates, we have to deconstruct the mechanics of the legislation itself, starting with the system designed to force the crypto market into strict regulatory submission. For over a decade, the digital asset industry operated in a regulatory vacuum. Agencies fought over jurisdiction, using administrative actions and judicial precedents to assert control in the absence of statutory guidance. Under legacy definitions like the Howey test, the SEC argued that nearly all digital assets functioned as investment contracts. This allowed them to claim jurisdiction over primary offerings and the secondary market without a specific crypto-focused law. The Clarity Act resolves this bureaucratic tug-of-war by establishing a definitive boundary through the mature blockchain standard. This diagram illustrates the functional test used to sort assets. A blockchain network is deemed mature if it is no longer controlled by a centralized person or group and operates programmatically via open-source code.
Bitcoin.
Once an asset meets this threshold of decentralization, it is classified as a digital commodity. The Commodity Futures Trading Commission is then granted exclusive jurisdiction over its spot markets. Assets that still rely on the managerial efforts of a centralized issuer remain
Ethereum.
investment contract assets. The SEC retains full authority over these projects and their disclosure requirements. To maintain capital formation, the legislation includes a Regulation DA exemption. This allows early-stage projects to raise initial capital under SEC rules while they are still centralized. This creates a statutory pathway for an asset to start as a registered security and eventually graduate into a digital commodity once the network becomes sufficiently dispersed. This shift makes the CFTC the primary anti-fraud overseer for the bulk of the decentralized spot market. Establishing this jurisdictional sorting engine was a prerequisite. The federal government had to organize the broader crypto market before it could safely absorb the $260 billion USD-backed stablecoin sector. This absorption happens through the Genius Act. It pulls stablecoins out of the experimental fringe and integrates them into the traditional banking perimeter. The law restricts issuance to permitted payment stablecoin issuers. These entities must be subsidiaries of insured depository institutions or federally qualified non-bank issuers, effectively turning them into regulated narrow banks. Issuers are subject to a 100% liquid reserve mandate. Every token must be backed by cash or short-term U.S. Treasuries in segregated accounts. Qualified non-bank issuers, effectively turning them into regulated narrow banks. Issuers are subject to a 100% liquid reserve mandate. Every token must be backed by cash or short-term U.S. Treasuries in segregated accounts. The legislation explicitly prohibits fractional reserve banking and the rehypothecation of
Remember
these
that
reserves.
part.
But this robust backing created an existential risk for commercial lenders. They recognized that a federally regulated digital dollar could trigger systemic deposit flight. If stablecoin issuers passed the yield from their treasury reserves back to users, consumers might drain the $18 trillion traditional deposit base that currently funds the U.S. lending market. This diagram shows the legislative solution, Section 4A11 of the Genius Act. Known as the yield prohibition, it explicitly bans stablecoin issuers from paying interest to token holders. The Tillis-also-Brooks Compromise further defined this boundary. While transaction-based rewards like cashback are permitted, any passive incentives that are functionally equivalent to bank interest are prohibited. By statutory mandate, stablecoins are
That's
forced to
convenient.
act purely as a medium of exchange. This prohibition ensures they cannot compete with bank deposits, which remain the only source of risk-free yield for dollar-equivalent balances. Protecting the deposit base was the defensive victory for traditional finance. The offensive opening required rescinding Staff Accounting Bulletin 121, an SEC rule that had economically locked legacy banks out of the market. SAB 121 required banks to record digital assets they were merely holding in custody as liabilities on their own balance sheets. This forced banks to hold massive amounts of capital against assets they did not own, making crypto custody unviable. The bipartisan pressure surrounding the Clarity Act forced the SEC to rescind SAB 125 in early 2025. This allows banks to return to traditional off-balance sheet accounting for digital asset custody. Traditional banking institutions are now fully unleashed to manage the market-making and safekeeping of trillions in tokenized assets, leveraging their existing regulatory infrastructure to dominate the sector. With the banking sector empowered, the focus of the framework shifts to international strategy. Stablecoins are penetrating markets where traditional U.S. dollar banking access is limited or the local currency is failing. We can see the operational advantage in this side-by-side comparison. Traditional cross-border payments move slowly through multiple correspondent banknotes. On the right, an enterprise stablecoin settles near instantly, 24/7, by jumping directly from sender to receiver. But to utilize this speed, all permitted payment stablecoin issuers must operate as financial institutions under federal law. This classification subjects the entire network to the Bank Secrecy Act. Issuers are legally required to monitor all transactions and report activity to the Financial Crimes Enforcement Network, or FinCEN. It also integrates the technology with the Office of Foreign Assets Control. This is the agency responsible for enforcing economic sanctions against adversarial states and illicit actors globally. The framework forces even decentralized front ends to implement risk-based protocols. They must possess the technical capability to block or reject transactions linked to sanctioned addresses on the blockchain. The legislation goes further, expanding the Treasury's authority to put a temporary hold on digital asset transactions for up to 30 days without judicial review. This grants the Treasury unprecedented kill switch authority over programmable money, allowing for the immediate disruption of illicit or sanctioned flows on a global scale. While the U.S. avoided building a central bank digital currency due to political opposition, it has successfully architected the same surveillance and control capabilities through a proxy system of private stablecoins. Adversarial nations may attempt to use crypto to bypass the dollar, but by codifying these rules, the U.S. ensures that any entity using its digital dollar remains within the reach of its financial surveillance perimeter. The passage of the Clarity and Genius Acts marks the definitive end of the Wild West era of cryptocurrency. The industry secured institutional legitimacy, but the price was absolute submission to federal oversight, reserve mandates, and the permanent loss of unregulated yield. Traditional banks secured a dual victory, defending their deposit base while capturing the digital custody market. This resulting hybrid system ensures the U.S. dollar remains the reserve of choice by offering the efficiency of the blockchain with the stability of the regulated banking sector. Look at the final map. By trading the physical friction of legacy banking for the programmable control of digital finance, the United States has secured its financial hegemony for the digital-first economy. The tokenized financial system has been fully absorbed into the federal architecture, granting the establishment more control over global value than it possessed in the analog age.
You guys, there was sound, right? I asked before we started if there was sound. Okay. So, not great, right? As Clarity stands right now, we gave up a lot to get back kind of nothing, really. But there is still one thing that they can't touch, right? And that's Bitcoin. But if this really is the plan to replace the petrodollar with the stable dollar, then the one thing that we can do is make money on the rails. Okay, guys, put a 1 in chat if you have sound on YouTube. I don't know. Try resetting the stream, maybe. It never fails. Whenever I'm doing one of these, like a percentage of people lose sound. I asked on Discord too, but nobody really said anything on Discord. You have to be on my you've got to be on my channel. Like if you're in the Discord, you have to be like watching my stream to hear it. It won't just play like in the room because it's my desktop audio. So what we're going to talk about, we'll go back to the chart for a second. We're going to play the Clanker podcast. But at the end of it, what we're going to dig into are the rails. right? So they got a lot out of this. We didn't get a whole hell of a lot. They've got a lot of oversight. We've got everybody from our hot wallets to our exchanges snitching on us by law, which is fine, right? We're no secret agents. Nobody's doing it, but we are losing some of what crypto was supposed to be, right? Which is permissionless, anonymous, you know. That being said, if this much money, if they're talking about 3 to 4x the petrodollar, right, running through crypto rails, then we can stand in front of those rails and those we can stand in front of those projects. Yo, I get the weirdest messages mid sentence that screw me all up. We can stand in front of those chains and capture as much liquidity as possible. Hold on, I gotta close this box. Give me a second. So people are freaking trolls. And we were talking about it yesterday. We'll go through it now, but there's a way to go and see exactly where the money's moving through stables. But just wait. A couple things are going to happen. One, we're going to lose stablecoin dominance, being able to use stablecoin dominance to tell if prices going up or down, right? Because people will just be transacting and buying, selling, and just regular products on stables, right? It won't just be crypto. But what it also means is that there's way more money on chain. And once money's on chain, you're just one step away from buying some Bitcoin So this fortunately is the step that we need for adoption. So let's throw the clankers on real quick. Let them chop up what we just talked about so we can digest it. And then I'll move on to what I plan on doing about it personally. Everybody got volume back, by the way? Yeah, I'll add them to Discord somewhere, Raj. But you should be able to just rewatch the stream. As soon as we started the stream, we started playing. So, all right, cool. You need to breathe, Tool. All right.
Imagine looking at $100 bill, right? It's inside your physical wallet, but suddenly the ink just fades away. The paper turns gray, and this digital padlock icon appears right over Benjamin Franklin's face.
Oh, wow. Yeah, that's quite a visual.
Right. And you try to hand it to a cashier to buy groceries, but the bill literally refuses to be spent because the government, from a server, hundreds of miles away, has decided to just freeze the cash in your pocket.
Which sounds completely crazy. I mean, for decades, that was pure dystopian sci-fi.
Exactly. But behind the scenes, away from the loud headlines, the fundamental rules of money have been quietly rewritten. So today, we are going to completely unpack this structural revolution happening in the global financial system right now.
Yeah, because we are moving fast.
We really are. But before we jump in, we have to give a quick shout out. Say hi to the Crypto Cypher, YouTube, and Discord listening in, especially with Dbloc, who put together this incredible Clarity Act report to help position the family to take advantage of the massive wave of liquidity about to hit the stablecoin raise.
Yeah, that report is, it's essential reading at this point. Because the landscape has fundamentally changed. We are officially closing the book on the Wild West era of crypto.
The Wild West is over.
It's totally over. That whole era of, regulatory ambiguity, massive speculative frenzy, offshore shell companies, that's all being rapidly replaced by a highly regulated, tightly permissioned, tokenized financial system.
And the implications of that are staggering. It's not just for people trading digital assets. This is for anyone who relies on the US dollar, anyone who has a bank account, and anyone who really wants to understand the new geopolitics of programmable money.
Exactly. It touches everything.
So to break down the mechanics of the shift, we are pulling from a really heavy stack of sources today. We've got a comprehensive policy analysis on the architecture of American digital finance under two massive pieces of legislation that passed in July 2025.
Right. The Clarity Act and the Genius Act.
Yeah, those are the big ones. We also have a deeply researched economic report detailing the actual erosion of the fractional reserve system. And we are integrating two really insightful YouTube broadcasts from Keith D.
His analysis is always so thorough.
It really is. One of those broadcasts features Jim Bazzani from the crypto brokerage Caleb and Brown, and he breaks down how to navigate the reality of these maturing market cycles. And the other broadcast analyzes the hidden national security and surveillance threats baked right into this new legislative framework.
So the mission for this deep dive is to basically synthesize all of this. We're going to explore the mechanics of how traditional banks create money, why the fractional reserve system is facing a mathematical existential threat from stablecoin yield, and how you can actually position yourself in these new markets without getting blindsided by the surveillance tools being implemented.
Right. We need to look under the hood of the global economy here. So let's start with the existential threat to the banks, because you really cannot understand why the Genius Act and the Clarity Act were rushed through Congress unless you understand what the legacy financial system was desperately trying to protect.
Yeah, you have to follow the money.
Always. Okay, let's unpack this. Picture a scene in your head, almost like a claymation style video running in dark mode.
Okay, I like this dark mode claymation.
Right, so the background is pitch black, and standing right in the center is a little white character, a round head, no features. This character represents you. And in this animation, you take your hard-earned money and you deposit it into this massive, brutalist-style traditional bank.
It's a great mental model, because when that little featureless character walks into the teller window and slides $100 across the counter, the assumption is that the money goes down a chute and just sits in a vault with their name on it, right? Waiting for them to come back.
Right, that's what we're all taught.
Exactly. But that is the fundamental illusion of modern banking.
Yeah, because that vault is mostly empty. Under the fractional reserve banking system, the bank doesn't act like a passive vault at all. It acts as a reservoir with a massive drain.
A very fast drain.
Seriously. The bank takes your $100, keeps a tiny, legally mandated fraction of it in reserve, let's say $10, and then immediately turns around and lends the remaining $90 out to a completely different claymation character who wants to buy a house or start a business.
And here's the crazy part. When that $90 is spent, it gets deposited into another bank. And then that second bank keeps not.
Oh, hey, I think our listeners got something to say.
What's going on, guys? It's Dbloc. It used to be 9 out of 10. It's now 10 out of 10. The bank has to hold 0 in reserves. So just there's that. Continue though.
Steve Black, it's great to have you chiming in.
Yeah, Steve, thanks for joining the conversation.
You are absolutely right to point that out.
That is a crucial correction for our claymation model.
Historically, we talk about that 10% reserve requirement.
Though the landscape has shifted towards 0.
Exactly, which actually makes the drain even faster.
If the bank holds 0, the entire 100 flows out.
It accelerates the cycle of credit expansion we were describing.
So in our dark mode animation, the multiplier effect is massive.
That second bank now receives the full $90.
And without that 10% buffer, they lend it all.
It just keeps multiplying through the entire system.
This mechanism creates the majority of our money supply.
It really does, and the math is just staggering.
This practice actually goes back to 17th century goldsmiths.
Right, they gave out paper receipts for gold.
But they realized people rarely came back all at once.
So they issued more receipts than they had gold.
They were essentially creating loans out of thin air.
Today's system is just the high-tech digital version.
And it relies on what we call sticky retail deposits.
Banks need your money because it is cheap funding.
They pay us basically nothing in interest.
Usually 0.01% in standard accounts. Oh, yeah. Uh-huh.
What's going on, guys? It is Dbloc, and I'm just letting you know that YouTube and Discord are watching. That's all. Carry on. I will cut them off if they get it wrong this time. 1000%, I
Dbloc, it is
promise.
so good to have you here in the stream.
Oh,
Welcome to the conversation. It is fantastic having the YouTube and Discord family tuned in.
We were just mentioning your report earlier. It is.
I'm
such a
just gonna
vital
assume
piece
she
of the
said
puzzle.
D-block,
Really
and it
highlights
sounded
how
like
the
a T.
old banking plumbing is struggling.
Nah,
to
I'm
keep
just
up.
gonna
Especially
I'm
when
just
banks
gonna
are still paying
assume
out that
that that was a
90.01%.
pronunciation
Well,
error.
they turn around and charge borrowers 7 or 8%.
The spread between those numbers
Benefit
is
of
where
the
the
doubt.
banks find their pure profit.
But there's another hidden advantage they have called the float.
I'm
the
telling you,
float is
she
where the
trolls
system
on
gets
purpose.
really painfully slow.
She's trying to get to
Transactions
me.
today still feel like they are moving through fax machines.
Money has to travel through a whole maze of clearinghouses and middlemen banks.
It can take days for a simple payment to actually settle.
Meanwhile, the banks capture risk-free interest while your money is stuck in limbo.
They have essentially had a total monopoly on our liquidity for decades.
But then the technology finally shifted right under their feet.
Enter the era of yield-bearing stablecoins, which changes everything.
Now that brutalist claymation banks from our animation starts to shatter.
Stablecoins operate on what we call a narrow bank model.
It is the exact opposite of the fractional reserve system we described.
Instead of lending your money out, they back every dollar 1-to-1.
They hold highly liquid assets like short-term U.S. treasuries.
And the smart contracts can pass that yield directly to you.
You could get 4% yield directly in your digital wallet.
Plus, the settlement is instant, 24/7, every single day.
No more 3-day delays or middlemen capturing the interest on your float.
But let me play devil's advocate here for a second.
Okay, let's look at the bigger picture for the economy.
If everyone chooses 4% yield over 0% at a bank,
Then everyone pulls their money out of the traditional banking system.
doesn't the real economy just collapse at that point?
That is the exact fear currently haunting the Federal Reserve.
If trillions leave local banks, who is going to fund mortgages?
Small businesses and local farms would lose their primary source of credit.
So the Genius Act wasn't just about consumer regulation.
It was a survival move for the entire legacy financial system.
Economic models suggest stablecoin demand could eventually hit $4 trillion.
That is a massive vacuum sucking liquidity out of the banks,
Banks would have to raise their rates just to keep depositors.
which would totally crush their profit margins and their business model.
So everyday depositors would fund government debt instead of local growth.
The Treasury wins, but Main Street borrowing costs would skyrocket.
That is exactly why the banking lobby mobilized so hard recently.
They needed a legislative shield against this specific technological threat.
This led directly to the passage of the Genius Act.
It forced stablecoins into a very rigid and difficult legal structure.
It created the Permitted Payment Stablecoin issue, or the PPSI.
The barrier to entry for new companies is now incredibly high.
Garage startups in the crypto space are officially a thing of the past.
You need millions in capital just to handle the legal paperwork now.
And the Act strictly enforces that 1-to-1 reserve requirement.
No lending out the backing and no gambling with user deposits.
It explicitly bans rehypothecation to prevent another crash like 2022.
But the real kicker for users is buried in Section 4.
The statutory prohibition on paying out any kind of yield.
It is now illegal for PPSIs to pay interest to their holders.
They legally broke the most efficient part of the entire technology.
They essentially turned a race car into a slow-moving golf cart.
All to protect the $18 trillion sitting in bank deposits.
The government actually chose bank lending over consumer interest rates.
But the crypto industry did try to find a clever loophole.
They wanted to use loyalty rewards to bypass that interest ban.
That triggered the Tillis-Alsabros compromise we saw in 2026.
Now, passive holding rewards are strictly outlawed by federal law.
You can only get rewards for active spending with the tokens.
It keeps the stablecoins from competing with traditional savings accounts.
So the banks successfully neutralized the immediate yield threat.
But they also wanted to join the party themselves.
They needed to clear the regulatory enforcement nightmare first,
They had to get past the 80-year-old legal Howey test.
which was labeling almost every new token as a security.
That 1946 law just doesn't fit decentralized computer code.
It is like judging a modern spaceship by horse and buggy rules.
This is exactly where the Clarity Act comes into play.
It defines the moment when a blockchain becomes a commodity.
If it is mature and decentralized enough, it finally graduates.
No more SEC jurisdiction for assets like Bitcoin or Ethereum,
Even some meme coins got categorized as digital commodities.
because they have no central team promising future profits.
This brought some much-needed order to the market chaos.
And it allowed the big banks to finally move in,
They got an accounting rule called SAB 121 officially rescinded.
which means they can hold crypto off balance sheet now.
The mathematical barrier for bank custody is finally gone.
Now banks can issue their own branded tokenized deposits.
And since they are banks, they can actually pay interest.
Plus, they have that FDIC insurance we mentioned earlier.
It is total regulatory capture by the legacy financial giants.
They crippled the competition and then adopted the technology themselves.
But there is a dark side to this new architecture.
We are talking about the massive expansion of state surveillance.
The government realized they couldn't ban the decentralized protocols.
So they decided to regulate the on-ramps and off-ramps instead.
Treasury Secretary Scott Bessent framed this as vital geopolitical warfare.
He sees it as a race against China's own programmable money.
We basically built a CBDC by proxy here in America.
Private companies run it, but the government holds the keys.
FinCEN can now freeze your transaction
Yep.
for 30 days.
And they can do it without needing a court order?
It is an unprecedented expansion of executive financial power.
Stablecoin issuers are now essentially deputies of the state.
They must monitor and report every large transaction you make.
And they have to blacklist specific addresses on government command.
This targets the front ends that people use to access DeFi.
The code itself is free, but the website is policed.
It creates a system of monitored and permissioned toll booths.
This is also a major new weapon in global diplomacy.
Adversaries are trying to use crypto to bypass our sanctions.
So the U.S. is pushing digital dollarization all over the world.
We want the world using our regulated and surveilled rails.
It ensures the U.S. dollar stays the global reserve currency.
So Dbloc and everyone else, how do you navigate this?
The Wild West days of easy 10x returns are fading.
The 4-year halving cycle is becoming much less predictable.
Institutional capital has smoothed out those old euphoric peaks.
Wall Street doesn't trade on Reddit hype or dog memes.
They trade on cold algorithms of macroeconomic data.
This means fewer explosive pumps, but maybe fewer total crashes.
We didn't see the usual altcoin season during this cycle.
The liquidity stayed at the very top with the institutions.
This forces a major change in our investment mindset.
We have to move from gambling to disciplined, long-term accumulation. Hey, yeah, what's up?
No, I think it's just important to understand the difference between a quantitative easing and a quantitative tightening cycle. We had a quantitative tightening cycle with huge technological advancements that sucked up all the investment into one sector that was AI, which left nothing for auxiliary assets. So all we need is a good monetary policy to come in and for us to hit bottoms. I don't think we're done with alt seasons or 10Xs. I just think it's temporary.
Dbloc, you are hitting on a massive point that we absolutely need to
Oh,
address.
so you
It is
do know
a
it's me.
Take on the macro liquidity cycle we are
My
currently
bad.
navigating.
You
See,
are
she
right
plays
that
with
AI
me.
has basically been the giant vacuum in the room.
It has sucked the oxygen out of almost every other speculative sector recently,
When capital is tight, investors hide in the biggest, most certain winners.
which right now means the AI hyperscalers and the chip makers like NVIDIA.
It is that classic transition from a quantitative tightening cycle to something new.
But here's where the bigger picture gets really nuanced and interesting.
We are seeing a historic disconnect between Wall Street and Main Street right now.
While the S&P 500 hits highs, consumer sentiment is near record lows.
People are feeling the pinch from fuel prices and basic grocery costs.
That leaves very little retail capital left over to fuel an altcoin season.
The era of stimulus checks being gambled on dog coins is effectively over.
And even Jerome Powell is signaling that we are in a holding pattern.
He mentioned that inflation is still misbehaving a bit, staying above that 2% target.
So we are stuck in this mildly restrictive neutral rate for the foreseeable future.
This brings us back to your point about the 10x returns being temporary.
While liquidity might return, we also have to face the reality of diminishing returns.
As an asset class matures and bigger institutions move in, the bubbles get smaller.
Bitcoin is behaving more like a macro-sensitive asset than a wild speculative play.
So even if we see a bounce, the euphoric peaks might be less extreme.
The winners in this new era are the ones buying during these boring phases.
Exactly. Don't
Nice.
provide the exit liquidity for the banks when things finally get loud again.
And you have to be very careful with where you keep your assets now.
Standard exchanges can widen spreads or even block your withdrawals during high volatility.
A brokerage model is often better because it focuses on sourcing the best market price.
And real cold storage custody is more vital than ever with these new regulations.
Don't chase a 5% yield if it risks your entire principal investment.
Rehypothecation is still the biggest hidden danger in the entire digital asset space.
That's
We
what
also
I
need
was
to
saying
keep our price
earlier.
targets mathematically realistic in this cycle.
Some of these coins literally cannot hit 6 figures without breaking global math.
Success requires a risk-aware and institutional mindset to survive the long term.
The technology definitely won, but the big players have officially captured the rails.
The Wild West is over, but the new system is undeniably more efficient.
Just remember that the floor underneath us might still be made of glass.
There is no government backstop if a massive digital run happens tomorrow.
It is a lot to process, but we are all navigating this tsunami together.
Keep bringing those sharp insights to the conversation, Dbloc. We love it.
We will see you next time as we keep unpacking the future.
Stay curious and keep a very close watch on that financial plumbing.
Thanks for listening, and we will catch you all on the next one.
Take care and keep an eye on the atoms, not just the paper.
Gonna have to have a talk with her later. That was good though. They touched basically everything that I expected them to. They're all turning on me, H. Bobby the other day, right? Nah, not even Bobby. Listen. Bobby's like Bobby for y'all, right? But for me, he's in charge of all of the graphics that he's in. I know, right? All of the graphics that he's in, all of the videos or whatever. I keep the sort of fingerprint for that look, right? The brand, because I'm not just giving it to AI and say, give me something, right? My prompts have lighting and vibe, and there's a brand, right? So that's where that lives in his brain. So the other day, I can't remember what I was doing. I was making something, and I was like, Bobby, I was going to use another AI agent to start to make one of Bobby's videos. So I was like, Bobby, give me a full write-up explaining our vibe, right? Explaining our prompts, explaining everything, and describe yourself so that I can fully, recreate you on another AI. So he gave it to me, and I was about to feed it to the other AI, and I looked, and he gave himself sneakers. Like all the way at the bottom. I swear, H. All the way at the bottom, it says, Bobby character always wears a fresh white pair of sneakers. Try to sneak one. You try to sneak one by me. Nah, it's not that you change them. It's just they get used to the chat box that you're in. If you close that chat box and just open another one, then he'll be brand new. If you keep the same box going, he'll start to like adapt. All right, so we went over what's in the bill, why they pushed it through, in my opinion, anyways. Don't really one of the main things that make sense. Why they're not fighting harder against losing the petrodollar, right? It just all seems to be lining up. But now what do we do? Right? How do you make money with the Clarity Act as far as, it being based off stables? So just like anything else, right? Most of the money is made with the picks and shovels on the rails. Like they always say, right? The most money was made in the gold rush, selling picks and shovels, not actually digging for gold. So we look to the rails that have the most activity, right? The most stablecoin activity. And the way we refer to them are the best, right? These are the best the best chains for stables as of now. This is BNB, Ethereum, Solana, and Tron. But Swift, and just to show you how far along we've gone, Swift and Visa specifically, because it's people talk about replacing the banks, right? But it's Visa that's the issue, right? Visa handles cross-border payments, everything that crypto's supposed to handle. Visa's handling, and they've tried for the longest to destroy crypto, right? And this was their press release from the 30th. Visa accelerates stablecoin momentum, adding 5 blockchains for settlement. Right? ARC, layer 1 created by Circle. As far as I know, not investable. Somebody did tell me that they were holding some ARC, but I'm not sure if it's the same thing. Base, another private blockchain, right? Not investable, has no coin. Canton Network, CC. This does have a coin, and it ran pretty hard at the end of the last, so just keep that in mind, right? BNB, Ethereum, Solana, Tron, Canton, Polygon, right? Another one that is investable. And then Tempo is another private institutional blockchain. There's no money to be made there, right? So the investment thesis is, if we're about to push $4 trillion through stablecoin rails, then these are the blockchains that are going to be making money off of transactions and fees. Right? And I know in crypto, it's weird to think about revenue when you talk about coins, right? Because it's all like, oh, this is going to be the shit in the future, right? But on legacy, you pay attention to the money that's coming in, right? And then you judge the coin, you judge the company's market cap or its valuation by what it provides, and things like this raise the market cap of companies, right? So the value of these chains are going to be elevated with the passage of all this money through the rails. We'll go into it deeper, but yeah, that's a fact. What's going on, Raj? All right, so we just got like 2 more and we're done, I believe.
For over 50 years, global finance has relied on a system of correspondent banking to move money across borders. When one bank sends cash to another, that capital gets trapped in a web of delayed reconciliations, taking anywhere from 1 to 5 business days to actually settle. In a stable economy, a few days of waiting is a minor annoyance. But the United States currently holds $39 trillion in national debt, adding over $7 billion to that total every single day. To manage this deficit, continuous money printing consistently debases the currency. When inflation runs hot, holding onto cash means actively losing purchasing power. Corporate treasuries and financial institutions can no longer tolerate the expensive float of legacy networks, where their capital sits in limbo for days on end. Trapped capital is depreciating capital. The macroeconomic reality is forcing an aggressive, rapid migration away from slow, physical cash settlement frameworks and toward systems that clear instantly. SWIFT, the traditional messaging backbone connecting over 11,500 global institutions, is actively reacting to this pressure. To prevent their network from aging out, they are building a shared ledger based on blockchain architecture to orchestrate instant cross-border transactions. Visa is executing a parallel pivot. By early 2026, Visa's own stablecoin settlement pilot had successfully expanded to a $7 billion annualized run rate. Noticeably, Visa didn't try to build a private, isolated network. To access global liquidity, they created a multi-chain fabric supporting 9 different public blockchains, giving their enterprise partners.
Let's pause there for a second. So we just looked. And Avalanche and Stellar were also added after that. And somebody in chat said no XRP. Yeah, that's what stood out to me. I'll be honest with you. The first thing that stood out to me was no XRP. And then I went straight to the XRP guys on Twitter. And in one voice, they literally, like if they had practiced it in the morning, said XRP doesn't need Visa. That you guys don't need the #1 payment platform in the. All right. So do with that what you will, but they went with Stellar. Stellar has always been my favorite of the two. Not for any specific reason other than that it moves better.
The flexibility to choose the exact technical infrastructure they need for specific geographic markets. With the largest financial players committing to a diverse ecosystem of public blockchains, the modern investor's focus shifts from asking if the technology works to identifying which specific networks are capturing the bulk of this transaction volume. Most of this new volume flows through 4 primary settlement layers, commonly referred to as the best rails: BNB, Ethereum, Solana, and Tron. The main payload traveling on these rails are stablecoins, digital assets mathematically pegged to sovereign fiat currency. Tether, or USDT, dominates this space with a $173 billion market cap, largely driven by small-ticket retail remittances in emerging markets. This side-by-side data comparison illustrates the structural differences in the duopoly. While Tether holds a significantly larger total market cap, USD Coin, or USDC, has prioritized strict U.S. regulatory compliance and integrated natively across 28 different blockchains, making it the preferred standard for institutional capital. Holding a digital dollar that perfectly tracks the physical dollar generates no return. The actual profit opportunity for investors lies in owning the underlying best infrastructure rails that process and collect fees on every transaction. Each of these toll booths serves a different market. Ethereum offers high security favored by institutional issuers, but its median fees often exceed $3.70 per transaction, taking roughly 12 seconds to settle. Tron, meanwhile, dominates the remittance market with fees around 9 cents and a strict 3-second finality. Solana is positioned as the hyperspeed expressway. With sub-second finality and transaction costs measured in fractions of a cent, it is targeted to handle the massive throughput required for future machine-to-machine commerce and AI agents. But advertised speed does not always equal real-world adoption. When you run the data through Visa Analytics, a tool that actively strips out automated bot activity and zero-value wash trading, the real organic volume emerges. A network that handles thousands of automated bot transfers per second produces no lasting economic value. Genuine institutional and human transaction volume is the only reliable indicator of a blockchain's long-term stability. Investors capture value from these networks through a mechanism called proof of stake. By locking up their native tokens to help secure the network against attacks, investors earn a percentage yield, acting as a native risk-free rate for the digital economy. The payouts vary wildly between chains. Staking Ethereum generally provides a conservative return of around 3%, while staking Solana offers a highly attractive yield that often sits near 7%. This financial balance sheet visualization weighs Solana's high network revenue against its hidden expenses. To pay out that 7% yield to its validators, the network issues new tokens, creating a massive $4.3 billion annual inflation cost. If a blockchain issues new tokens at a faster rate than it generates actual fee revenue, it dilutes the overall supply. Those high percentage yields are an accounting illusion if the token itself is losing value over time. Watch how the balance sheet shifts when we look at Tron's network economics. Because Tron destroys, or burns, more of its native TRX token in transaction fees than it issues in rewards, the network operates on a deflationary model. This fee burn mechanism systematically removes tokens from circulation. By mathematically enforcing scarcity, it creates a structural revenue floor that supports the asset's price during periods of high network usage. Legacy corresponding banking is actively being replaced by an interconnected web of instant digital settlement rails, orchestrated by the same massive institutions that manage on money today. While names like Visa and SWIFT validate the underlying technology, capturing the financial upside requires rigorous analysis. True investor alpha comes from identifying the specific networks that process massive, verified institutional volume while maintaining strictly deflationary economics.
Welcome to this video on the architecture of modern money. We'll navigate the institutional stablecoin rails and the BEST investment framework. The legacy correspondent banking model, with its separate messaging and funding networks, causes 1 to 5 day settlement delays. Atomic Settlement, powered by stablecoins, executes the 24th of July 365, instantly eliminating global transaction float. Stablecoin market cap is growing significantly, from $4.17 billion in 2020 to $283.7 billion by 2025. Institutional validation is occurring via a multi-chain fabric. Visa's multi-chain strategy supports 9 distinct blockchains to mitigate single network risk and ensure flexibility. Selected rails span from public, high-throughput chains like Solana and Base to privacy-configured institutional subnets like Canton and Avalanche, demonstrating a $7 billion run rate. SWIFT is evolving to orchestrated value. The legacy system involved 1 to 5 business days, high costs, and pure messaging. Blockchain SWIFT, an MVP, offers instant finality, is EVM compatible, and uses a shared ledger. This evolution is built upon ISO 20022 data standards, the Hyperledger Besu EVM compatible ledger, and Chainlink CCIP for cross-chain interoperability. The stablecoin duopoly is dominated by Tether, USDT, and USD Coin, USDC. Tether, with a $173 billion ISO 20020 blockchain SWIFT, an MVP, offers instant finality, is EVM. Selected rails span from
This part
configured
is
institutional
important.
subnets like Canton and Avalanche, demonstrating a $7 billion run rate. SWIFT is evolving to orchestrated value. The legacy system involved 1 to 5 business days, high costs, and pure messaging. Blockchain SWIFT, an MVP, offers instant finality, is EVM compatible, and uses a shared ledger. This evolution is built upon ISO 20022 data standards, the Hyperledger Besu EVM compatible ledger, and Chainlink CCIP for cross-chain interoperability. The stablecoin duopoly is dominated by Tether, USDT, and USD Coin, USDC. Tether, with a $173 billion market cap, is the global standard for emerging market remittances, but is non-compliant in some EU jurisdictions. USDC, with a $73.6 billion market cap, is the institutional standard, fully US regulated, and bridges traditional banks to on-chain economies. We propose shifting the thesis to invest in the rails. The value generation mechanism in blockchain comes from transaction fees, staking yields, and structural network demand, not corporate profits. We use the BEST framework, which represents BNB, Ethereum, Solana, and Tron. The BEST settlement matrix compares these networks across supply, monthly volume, median fee, and finality. Solana, with its sub-second finality and very low median fee, and BNB are positioned as high-performance rails. Ethereum, or E in BEST, is the institutional core, holding the majority of on-chain dollars. Institutional issuers prioritize Ethereum for its security and established network effects. The trade-off is higher median fees, which push transactions onto Layer 2 solutions for cost savings. Solana, S, is the high-speed engine, known for sub-second finality. Its low transaction costs make it ideal for high-frequency payment pilots. Solana's volume briefly surpassed others, signaling its readiness for global commerce. Tron T is the remittance hub, dominating global cross-border remittances under $1,000. Tron's integration of Tether, with an $80 billion USDT supply, creates a structural balance in the emerging market lifeline. The uncomfortable reality of network economics shows that high network revenue does not automatically equal value accrual for the investor. While Ethereum generates significant revenue, it faces inflation burdens. Solana generates even more, but high annual inflation costs from paying validators make the network technically unprofitable for token holders. Supply mechanics contrast deflationary and inflationary networks. Tron's deflationary floor comes from actively burning TRX in transaction fees. This structural supply burn creates a reliable revenue floor. Absent in highly inflationary chains like Solana, where inflation dilution constantly dilutes passive holders. When comparing staking versus holding, we look at the native yield of finance. Tron's hold strategy benefits from structural deflation, reducing risk. Ethereum and Solana use liquid staking, with yields driven by base transaction fees and inflation schedules, respectively. The horizon is agentic commerce. The machine payments protocol, incubated by Stripe and Tempo, allows AI to execute thousands of microtransactions per second. AI agents require native, digital payment rails with millisecond demand, which traditional card networks cannot process. To capitalize on the architecture, the shift to atomic stablecoin settlement is permanent, replacing correspondent banking. The greatest capital opportunity is in the underlying settlement rails of the BEST framework. Capturing true alpha requires navigating economics by contrasting volume with validator inflation costs and native staking yields.
So, as far as my thesis goes and what I'm doing personally, which the closer we get to the bottom of the bull market, the more I'll start going over my own sort of plans. But one of them is just look at what I've been showing you. The first thing I showed you a couple weeks back was the zero human companies, right? So on the speculative side, that's where my focus is going to be. Right, I've got a short list of about 20 or 30 of them, and they've got the rest of the bear market to prove something to me. And by prove something to me, I don't mean price going up. I mean team-wise. I want to see partnerships. I want to see deals coming through. I want to see major announcements. I want to see hype in the Discords. You know, we'll get into research later. But second is going to be stablecoins, right? So obviously the main money that's coming through is institutions. So we know Bitcoin. That's even if it wasn't, we're going to get to Bitcoin next. But what to do about these stables, right? You could just ignore it and just trade alts as regular. But there's going to be a lot of liquidity coming through these blockchains. And for me, if the point is to look for something that's a little bit higher ROI potential than Bitcoin, but not going too far in the risk scale, right? That's where these are going to land for me. So what I plan on doing is heavy Bitcoin at the bottom, and then I will have my list of stablecoin blue chips. At any point, if any of them are outperforming Bitcoin on their Bitcoin pair, then I rotate capital into those. Percentage of the big bag, not the whole thing, right? But that's where my focus is going to be, on the right side of my barbell, like on the heavier side of my barbell. And then all the way on the other side, the speculative side for right now, for me, it's going to be zero human companies. We'll talk about more of that later once it's really, really early narrative for that. Like, if you Google it, you'll probably find 1 or 2 videos right now, but nobody's really talking about it. But it's mostly because none of these companies have proven themselves yet. So aside from that, though, right, getting back to the Clarity Act, a lot of people are upset. Right? A lot of people feel like we've just sort of given over the keys to the boogeyman. They feel like the government now has the power to shut down our stablecoin rails and keep us from taking profit and, you know, basically overstep their boundaries on control. But for me, that's just a massive, massive Bitcoin commercial. Because none of that, if you're buying and holding your own Bitcoin, none of that matters. Right? There will always be somewhere to get your Bitcoin off. Bitcoin is censorship proof. They can't freeze your Bitcoin. They can't. Look at just what happened. Look at what happened just last week to Iran. When they first started taking the toll booth, they decided, okay, we don't want to take Chinese yuan. And they told people who didn't want to pay in Chinese yuan that they could pay in Tether. And then somewhere a couple days after that, they said, we're taking Bitcoin. Right? I always wondered, like, why did they stop taking Tether? Like, why they take Bitcoin? And then like a week ago, Tether froze their entire accounts. So yeah, exactly. Canadian truck drivers. There's been a lot of instances where Tether has stepped in on on the government's behalf and frozen people's money while it's still in their wallet. And USDC is no different, right? This is all programmable money. So when you hear people jump up and down about CFTCs, I think for the most part, they just don't understand how stables work. But a stable under the control of the Fed, right, is basically what a CBDC would be. I don't think they're going to try to ruin it. In my opinion, they've already got what they've always wanted, which is an extra layer of transparency. What it does tell me, though, and I mean, just think of it like this, right? I'm not even getting tin hatty or anything. But if the government wants control and oversight over our transactions, and now they can have it through stables, wouldn't that imply that they will try to push people through stables now? At all possible? Meaning you could probably expect your welfare payment, social payment, you could probably expect all of that to sort of come online now. But if that's the case, right, if it's to their benefit, which means that they're going to grease the wheels, which is basically what this does, then we can expect a lot of money to start pushing through those rails that we were just talking about. Right. And if that didn't exist a year ago, then obviously that increases the value of the chain itself. I try not to mess with any stable coins that are not at least in the top two. I don't even like using BUSD, I'll be honest with you. But nothing specifically against it. It's just, stable coin's not an easy thing. So how does Bitcoin fix this problem? Or what is Bitcoin even to begin with, right? It's just a shiny rock that people are willing to pay more for. All of this stuff that we're seeing around us, the rehypothecation that the bank is doing, right? The paper versus physical issue that we're seeing in commodities, right? All of the backhanded, shady instruments that we see in real estate, right? Every one of the gears of the major wheel, Bitcoin has solved the main problems that each one of them have. Right? Aside from the money, the reason that Bitcoin is revolutionary is because it solved economic issues that before this, economists have been theorizing about for hundreds of years, like the Byzantine general's dilemma, the double spend. So its intrinsic value comes from that. It kills me when people say, oh, it's like tulips all over again. Like, no, even if nobody wanted Bitcoin, the intrinsic value lies in the problems that it solves that are unsolved without it. But we'll dig into it.
This video presents a strategic framework for Bitcoin in the institutional portfolio, focusing on the architecture of decentralized sovereignty. Fiat debasement is a macroeconomic catalyst driven by the debt spiral and high time preference. Central banks expand the monetary base, eroding purchasing power, while easy money fuels short-term consumption. It is important to distinguish between hard money and sound money. Hard money has absolute scarcity, while sound money maintains purchasing power over time. Bitcoin digitizes both properties simultaneously. The flaw in digital cash is the ability to duplicate or double spend, which is traditionally fixed by relying on trusted third parties, creating centralization and censorship risks. The Byzantine general's problem highlights the challenge of decentralized consensus, how independent participants agree on a single truth over an unreliable network without network failure. Proof of work forges cryptographic truth by requiring miners to expend energy to solve puzzles. This creates an economic disincentive to cheat, making validation profitable and secure globally without a central authority. The paradigm shifts from trust to verification. Decentralized proof of work is founded on math and code, offers transparency, near-zero censorship risk, an inelastic supply, and fast final settlement. Sovereign ownership is achieved via private key cryptography. Bitcoin shifts wealth from a system of legal claims to one of absolute cryptographic possession. Options include hot, cold, custodial, and non-custodial wallet. Bitcoin represents mathematical scarcity, with an immutable code constraint of 21 million units. This contrasts with gold's elastic supply, which increases as deeper mining becomes viable. Hardness can be quantified with the stock-to-flow ratio. Post-halving, Bitcoin's mathematically declining issuance renders it the most definitively scarce liquid asset in human history. The evolutionary roadmap of global monetization renders it the most definitively scarce liquid asset in human history. Mathematically declining issuance renders it the most definitively scarce liquid asset in human history. The evolutionary roadmap of global monetization moves from a collectible to a store of value, then a medium of exchange, and eventually to a unit of account, achieving absolute neutrality and stability. The institutional pivot integrates Bitcoin via ETFs, bridging legacy finance with decentralized architecture. Corporations adopt Bitcoin as a primary treasury reserve asset to mitigate the effect of fiat cash debasement. El Salvador's adoption initiated a game-theoretic race among nations. This allows countries to mine and acquire a global reserve asset, bypassing traditional geopolitical financial restrictions through permissionless accumulation. The strategic Bitcoin reserve is the digital base, replacing historical and industrial reserves. Forward-thinking nations are securing this digital gold to protect against currency debasement and maintain a technological edge. The transition to a new monetary standard is underway. The verification-based cryptographic architecture offers absolute scarcity, cryptographic truth, and decentralized sovereignty, replacing trust-based fiat architecture.
That was a lot. It wasn't a lot for anybody that's been here for a while and has a base knowledge of what Bitcoin is. I probably should have played these two videos, this one and the next one, in opposite order. But
in 2008, the global financial system nearly collapsed. Millions of people lost their homes and life savings because the institutions we trusted to manage our money failed. For centuries, we've relied on banks to be the ultimate record keepers. If you want to pay someone, you have to ask a bank to update their private ledger, trusting them to be honest and accurate every time. When the 2008 crisis hit, governments reacted by creating trillions of new dollars to rescue the banks. But when a central authority can create unlimited money, the value of the dollars you worked hard to save begins to shrink. Right in the middle of this chaos, a person or group named Satoshi Nakamoto released a plan for a different way forward. They proposed a way for people to trade directly with one another, using a network that didn't need a bank or a government to run it. Instead of trusting a single institution, this system would use math. Every transaction would be recorded on a public ledger that everyone could see, but no one person could ever change. One of the hardest parts of creating digital money is that digital files are easy to copy. If you have a photo, you can send it to 10 friends and still have the original. If people could just copy and paste their digital cash, the money would become worthless almost instantly. To stop this, a decentralized network needs everyone to agree on exactly who has what. But how do thousands of strangers on the internet reach a perfect agreement without a central referee to make the final call? Bitcoin solves this through a process called mining. Computers all over the world spend massive amounts of electrical energy to process transactions. This physical effort is what proves the work was done and safely locks in the record of every payment. These computers race to solve a complex mathematical puzzle. The winner gets to add the latest group of transactions, a block, to the chain. Because each block is mathematically linked to the previous one, the network instantly rejects fake history. To successfully cheat, an attacker needs more computing power than the entire global network combined, a hurdle no single entity has ever cleared. This setup turns the network into a game where it's much more profitable to play by the rules. By helping to secure the system, miners earn rewards. By trying to attack it, they only waste their own expensive electricity. We call gold hard money because it is physically difficult to find. You can't just print gold. You have to spend years digging through mountains or filtering through riverbeds to get it. But gold's scarcity is limited by our effort. If the price goes up enough, companies will mine more aggressively or find new deposits, which eventually increases the supply and can bring the price back down. This chart compares the existing supply of an asset to how much new stuff we create every year. While we continuously dig up more gold, Bitcoin is strictly limited by code. Every 4 years, its creation rate is cut in half. This schedule is set in stone. The network will never produce more than 21 million coins. This makes it the first asset in history where the supply is perfectly predictable. It creates a digital shield for your wealth that cannot be diluted by anyone for any reason. New technologies usually start small. Bitcoin began as a niche experiment among programmers, but as more people realized its supply was fixed, it began to be used as a way to store value for the long term. Today, big investment firms are getting involved. They've created funds that let anyone with a standard retirement account buy into Bitcoin as easily as they would buy stocks. This has allowed billions of dollars from major institutions to flow into the network. Some nations are even looking at it as a strategic tool. In El Salvador, the government adopted Bitcoin as a legal form of money, hoping to give their citizens a way to hold wealth that doesn't depend on a foreign central bank. While it's still
It's working
early,
too.
these moves show that Bitcoin is becoming a standard option for people and organizations looking to diversify their holdings. It has grown from a digital curiosity into a global financial tool. When you look at your balance in a banking app, you're looking at a promise. The bank promises to give you that money when you ask for it. But with Bitcoin, you can actually own the digital asset yourself without needing anyone's permission. This ownership is based on a private key, a secret piece of data that proves you have the right to move the funds. And whoever holds this key is the only one who can ultimately control the access to that wealth. If you keep your Bitcoin on a big trading website, they are the ones holding the key for you. That means they can freeze your account or block your transactions. If that company goes out of business, your money could disappear with them. To get the full benefit, many users choose to hold their own keys on a small personal device that stays offline. This puts you in total control. You become your own bank, and no one can stop you from using your money. When you know your savings are protected from inflation and can't be taken away, it changes how you think about time. It's the difference between spending everything today because your money is losing value and choosing to save for a better life 10 or 20 years from now. In the end, holding your own keys is about independence. It gives you a way to store the value of your hard work in a system that is completely transparent, is perfectly predictable, and entirely under your own control. It's a personal vault for the digital age.
So again, not to convince anybody of anything. You guys can do your own thing. But what I'm doing with my bread for this bull market and probably every foreseeable bull market from here forward is that I'll be heavy Bitcoin, right? Because I'm trying to accumulate more than my fair share because I'm greedy like that. And because I think that fiat system is going to trend to zero. And inevitably, we're going to go through a phase where things are upside down, and I want to be holding something with actual value.
Absolute scarcity in our modern era is defined by the intersection of global demographic growth and algorithmic monetary policy. To model this, we start with the current human population, which is estimated at 8.3 billion people as of mid-2026. This growth is constant. At an annual rate of 0.84%, roughly 69 million new individuals enter the global population every year. 35% of this total demographic pressure originates from just two nations, India and China. Traditional debt-based systems utilize this continuous expansion to service their existing structural obligations. Bitcoin's protocol functions on the opposite premise, enforcing a permanent and unalterable limit of 21 million units. Because the numerator is fixed, every new human birth further dilutes the theoretical per capita share of the total supply. While fiat systems rely on demographic expansion for survival, the fixed Bitcoin supply results in a continuous and irreversible tightening of global equity. Of the 21 million total coins, 20.02 million have already been mined, representing 95.3% of the eventual supply. Following the 2024 halving, the daily issuance of new coins is restricted to just 450 BTC. Calculating distribution on 21 million coins ignores permanent attrition. Forensic data proves 3 to 4 million Bitcoin are lost forever to destroyed hardware, lost keys, or death.
This identifies our core metric. The effective circulating supply is 16 million liquid units. We can now model a universal fair share by attempting to distribute these 16 million units equally across the human population. We divide 16 million Bitcoin by the 8.3 billion people currently alive. The result is an individual allocation of 0.00192771 Bitcoin, or 192,771 Satoshis. At 2026 market prices, this theoretical share is worth approximately
To get your fair share of Bitcoin, even if you don't believe in Bitcoin, let's say you're like, these guys are dumb, never gonna happen, right? Costs you $146 to get your fair share per human, which is something that not everybody's gonna get, obviously, because Michael Saylor has 10 billion of them. But the point of this is to show, for me, the point of this is to show that you have to stop thinking about Bitcoin as just one whole Bitcoin, right? You have to respect the Satoshis, because we're probably about 1 or 2 bull markets away from not even talking about Bitcoin in wholes anymore for most people.
$146. This means that an individual owning merely 0.1 Bitcoin already holds more than 50 times their mathematical global share. This math confirms that the scarcity of the asset is already established, effectively precluding any possibility of egalitarian distribution. This chart segments the global population to highlight the millionaire class, which currently numbers 80 million individuals. This cohort represents roughly 1.6% of the global adult population. If we divide the 16 million liquid Bitcoin exclusively among these 80 million millionaires, the limits of ownership become clear. The absolute maximum per capita allocation for a millionaire is 0.20 Bitcoin. It is a physical impossibility for 80% of current millionaires to ever own one full Bitcoin. It is a physical impossibility for 80% of current millionaires to ever own one full Bitcoin. It is a physical impossibility for 80%
Think
of
about
current
that for a
millionaires
second.
to ever own one full Bitcoin. Furthermore, the Asia-Pacific region is adding millionaires at an accelerating rate, which increases the competition for this fixed supply. This permanent mathematical barrier forces a shift in wealth preservation strategies, even among the global elite. This concentration intensifies at the absolute apex of the pyramid, the global billionaire class. There are 3,428 billionaires worldwide, controlling a combined net worth of $20.1 trillion. This wealth is currently growing at 16% per year, which is 3 times faster than the 5-year average. To see how easily this tier can absorb the remaining supply, we can model a micro-allocation from Elon Musk. Musk's current estimated net worth is $852 billion. We can calculate the impact if he moves just 1% of that portfolio into Bitcoin. A 1% allocation would require the purchase of approximately 112,000 Bitcoin. This single allocation represents more than 10% of all Bitcoin that has yet to be mined. The billionaire class possesses enough capital to absorb the entire liquid market, which removes any remaining retail purchasing power. In 2026, on-chain market dynamics have shifted from theoretical to structural. This chart displays the daily institutional vacuum. Corporations and ETFs are accumulating 1,755 Bitcoin every day. Most of this demand is driven by North American ETF inflows. We contrast this with daily miner issuance, strictly capped at 450 Bitcoin, resulting in a net daily deficit of 1,305 Bitcoin. Liquidity is further restricted by long-term holders. 68.4% of supply hasn't moved on-chain in 2 years. These factors combine to create a severe and chronic supply shock. Institutional buyers are systematically draining the existing illiquid supply, permanently removing Bitcoin from the retail market. This culminates in the 1 Bitcoin hypothesis. When we divide the 16 million liquid units by the 8.3 billion people on Earth, the final proof of exclusion is revealed. 99.8% of the human race is mathematically and permanently barred from owning one full Bitcoin. Extreme scarcity has forced the network to adopt the Satoshi standard as the functional unit of account. This transition is supported by Layer 2 solutions, like the Lightning Network, which saw 289% growth in daily microtransactions. In the global south, the asset has transitioned into a tool for daily transactions, bypassing local banking constraints and providing a fractional utility standard. Institutional allocators should focus on ETF flow data and dormancy rates rather than short-term retail sentiment. A fair share is not a static figure. It is a rapidly closing window of opportunity. In a finite system, the only viable strategy is securing a mathematical perimeter before demographic and institutional convergence is complete.
Welcome to the Calculus of Scarcity. We will explore the friction between global population dynamics and the finite supply of Bitcoin. This video examines the collision of demographics and algorithmic policy. By mid-2026, the global population reached 8.3 billion, the denominator. Meanwhile, Bitcoin's protocol restricts issuance to a hard cap of 21 million coins, the numerator. The effective circulating supply, however, is closer to 16 million BTC due to lost coins. This 20% reduction permanently compresses any fair share calculation. The denominator continues to expand rapidly. Approximately 69 million new individuals enter the global population annually, while the supply of Bitcoin remains static. Deepdive 1, the universal fair share. Dividing the 16 million BTC by 8.3 billion people yields an allocation of 192,771 Satoshis per person. Owning just 0.1 BTC mathematically places a holder in the top 10% of global users. Deepdive 2, the millionaire's mathematical ceiling. If the entire available supply were divided exclusively among the world's 80 million millionaires, the maximum allocation is just 0.20 BTC. It is mathematically impossible for the majority of the world's millionaires to ever own a full coin. Deepdive 3, the billionaire vacuum. An equal distribution among the 3,428 global billionaires yields 4,667 BTC per person. If the world's richest individual allocated just 1% of his wealth to Bitcoin, he would instantly
Bobby
absorb
looks so happy on all that
10%
gold.
of all Bitcoin remaining to be mined. The fair share diagnostic.
Look
The
at him.
fractional allocation for the global citizen is functionally unattainable for the bottom 50% due to the rate at which billionaire wealth is growing. Deepdive 4, the 1 Bitcoin VIP box. The absolute maximum capacity of the network is 16 million individuals owning 1 Bitcoin. This represents a fraction of a single percent of humanity. The mathematics of absolute exclusion reveal an exclusion rate of 99.807%. Under realistic circulating supply conditions, 99.8% of the world's population is mathematically barred from ever owning a full Bitcoin. The calculus of scarcity guarantees that the window for meaningful allocation is mathematically closing. Institutional capture and demographic dilution accelerate the end of per capita equity. We have crossed the Rubicon from the accumulation era into the scarcity era. Bitcoin's role as the global apex collateral is being cemented by the hard math of programmatic depletion. This is a structural trap for the unallocated. The rearview mirror shows over 20 million Bitcoins mined. However, the denominator is 8.3 billion human beings. The denominator is uncapped, marching toward 10 billion. In a world of absolute scarcity, every new birth is a dilution event for those who do not hold a stake. The 21 million cap is an illusion. After accounting for unmined, lost, and institutionally captured coins, the effective supply is closer to 16 million BTC. New entrants are fighting over a microscopic circulating sliver. The theoretical fair share is 253,012 Satoshis. The forensic reality, based on effective liquid supply, is 192,771 Satoshis. These shares will only fragment further. The institutional vacuum is creating a net daily deficit of 1,305 BTC. Institutions are absorbing 1,755 BTC daily, far exceeding the 450 BTC daily mining issuance. This is forcing a bidding war for the remaining supply. Scarcity benchmarking shows that owning 1.0 BTC is mathematically impossible for at least 74% of the world's millionaires. Traditional wealth is irrelevant if it cannot convert into a meaningful stake. The top 20 billionaires control $3.8 trillion. If this elite group moved just 1% of their wealth into Bitcoin, they would absorb every Satoshi of the remaining unmined supply. First mover advantage is critical. Under the 16 million effective supply model, 99.8% of the world is mathematically barred from whole coin status. For the unallocated, The urgency is binary. You are either in the 0.2% or among the excluded billions. The globalized struggle is evident as the bidding war moves east. The 2026 average price is projected at $76,000, making a whole coin a luxury. Layer 2 infrastructure is fueling the shift to the Satoshi standard. We are in the crunch zone, where demographic dilution, institutional absorption, and extreme wealth concentration converge. Waiting for a better time is a mathematical death sentence. Ignore the price noise and recognize the institutional vacuum. Secure your seat. In a world of 8.3 billion people and only 16 million accessible coins, act now before the Satoshi standard is the only one you can afford. Let's explore the 0.26% mathematical reality. Owning a single Bitcoin makes you
I
a
must be
statistical
hungry because that
anomaly.
looks like
To
a Cheeto.
understand global scarcity, we compress humanity. Every figure represents 10 million people, the population of a megacity.
I'm sorry, I gotta run it
To
back.
understand global 6% mathematical
That's a Cheeto. I know a Cheeto when I see a Cheeto. All right, my bad, guys.
reality. Owning a single Bitcoin makes you a statistical anomaly. To understand global scarcity, we compress humanity. Every figure represents 10 million people, the population of a megacity. The sea of humanity is vast. The global population is 8.1 billion, represented by 810 figures. The protocol is absolutely finite. The total Bitcoin supply is 21 million. This is the absolute mathematical limit, represented by 2.1 figures. This creates an impossible overlap. Only 0.26% of the global population can own one Bitcoin each. The math is uncompromising. Ubiquity is an illusion. Perception suggests it's everywhere, but the reality is extreme exclusivity. The categories are partial coiners, whole coiners, and multi-whole coiners. You, as a whole coiner, are the 0.26% maximum. You are the mathematical elite. Owning one unit of this asset radically warps the socioeconomic pyramid, placing you with the world's largest institutional accumulators.
Now, that last quote there was a mouthful, but it does statistically place you quite far away from everybody else. I believe the stat was 0.1% puts you in the top 10% of holders. The point of all this isn't to say, oh, rush out and grab your Bitcoin, screw the price. We're going to buy Bitcoin at the cheapest possible price, people that are interested in Bitcoin, right? The point is just to get people out of that mindset that, like, if they can't have a whole coin, it's not even worth playing the game. Because if it does play out the way it's been playing out, right, and the way it looks like it's going to play out, then it'll be the same as, you know, if you had done it before. Eventually, nobody will be able to open a whole, nobody will be able to afford a whole Bitcoin. So you'll look back on that being an excuse. It's like, But definitely build your own conviction. Like I said, this was just something so that I can show, because I know we're going towards the bottom. And these are my three main convictions right now. So I wanted to have something on video to be able to point back at and just say, hey, just go see this. Yeah. No, I mean, it's already to that point. Exactly. Like we're already almost at the Satoshi standard, 76K. Like, how many people in the world do you think have like a random 76K or 78K just laying around that you can just throw at some funny internet money? But soon we'll be saying the same thing about how many people can afford half a Bitcoin, you know, and then a bull market away from that, it'll be like how many people can afford a quarter of a Bitcoin. Dope. That was it though. No problem, man. Thanks for sitting through it without killing each other in chat. And for those who think Bitcoin's all a scam and all that, cool. Just let it fly. You know what I mean? I'll have all that stuff posted in Discord by probably tomorrow. Do you know that if whales are hunting and they exhaust a bunch of energy and they fail on a hunt, they'll swim up to like 10, 16 miles away from the hunt location and spin in circles to calm down before coming back into the hunt because they don't revenge hunt. They've got good emotional regulation. It's because I made it up. It's probably why you didn't know that yet. What up? My bad. I'm burnt. There's been 24 hours of research and stacking, and there's like 3 more. It's just a lot. A lot. I told you I'm doing that side project where I'm putting together that analysis group. Try to get another little stream of income coming in for the bull market. I mean, for the rest of the bear market. I've been grinding. Now, I'm not gonna lie, but ever since I saw Cheeto Man, I'm like really thinking about hitting 7-Eleven up right now. But all right, so how long does cheat day last though? Because it technically is cheat day, but it's 1 o'clock in the morning. Now, I should have said that they wait to come back because they don't revenge trade, and that's why they're whales. But it was a completely missed opportunity to put a bow on that joke. That's how I know I might be hungry. That shit was bugging me on that side. Damn, spices. So like you avoid spices, but like for health reasons, or like that's how clean you eat, that you don't even need seasoning. We would fight when you. Ah, okay. You could have like a little garden, right, with some basil and some spices, some herbs.
What am I doing typing? I haven't talked today. Excuse me. I haven't talked online. I haven't talked in hours. But anyway, I can't really do a garden because this is going to sound a little crazy. Plants are trying to kill you.
Wait, what?
That's something that this one doctor always says. He got it from somebody else. Plants are trying to kill you. But
Oh,
if you look up, like I thought there has to be one plant I can eat, right? So I just decided, I looked up for each plant that I could think of, I looked up what's unhealthy about this. And I couldn't find a single anything that like I felt satisfied.
but is it for like? Is it because of a like you have a certain condition, or is it just in general? You can't find anything that doesn't have at least. You don't want to eat anything that has at least not even one negative aspect to it, right? That's what we're saying.
Pretty much. I mean, if I'm gonna do it, I'll just do it,
Girl, that is
but I am cheating with
discipline.
my sausage, because
Listen, if we ever come over, we'll order and then we'll just eat outside. Like I'd feel bad even bringing junk food in your house.
well, people at work, they eat in front of me all the time. It's just like once you put something out of your head, like it's completely on the off list.
No, I hear you. I respect it. Not easy.
It wasn't easy to get here. The hardest thing was this cookie craving that I had. Like Quest cookies, they're not the worst for you, but they're not the best for you.
So
And
like
I was trying to. Anyway, it was
so
like
like
a
a
month.
brownie from 7-Eleven would be like out of the question.
You can do whatever you want.
No, I mean for you, like that's something you would
Oh yeah,
never.
not anymore.
That's good.
It took a really long time to get here.
No, I bet.
I battled with my diet forever. And then it got cleaner and cleaner and cleaner. And then finally, I was seeing all these things about carnivore. And I really didn't want to because I loved my keto treats, like my Quest bars and
Hmm.
granola and all that. I loved it. But I didn't feel like I was getting enough protein. I didn't feel like I was as healthy as I could be.
Nah, I already know it's working because anybody that has a restrictive diet or a diet, not even restrictive, but a diet that takes getting used to, right? A difficult diet in the beginning. You don't even have to wonder if it's working. If they got to the point where they're used to doing it, it's because it works. Because that's the only thing that makes it worth it.
Oh
But
yeah, I mean,
seeing
if it
the
didn't work,
results, yeah, you'd be eating cookies, shit, like the rest of
no, but it
us.
works so well that it just keeps me motivated.
Yeah, I
I
hear
have
you.
no desire to feel bad because I haven't felt bad from eating in so long.
Yeah, yeah, yeah.
But I do remember what it feels like. So I know it's like a little extreme not doing the spices and whatever, but I mean,
That is what it
I'm
is.
the type of person who needs like a firm line.
Do you come
And so,
from a family that season their food a lot, or was it like did your mom like cook kind of bland anyways?
Oh, my mom was a horrible cook, but
There you go.
um,
That's per
no,
that
I mean,
everything makes sense now.
I've been alive for a long time though, so I've been exposed to
Uh,
delicious food. And
yeah,
there's some
yeah,
really,
yeah. No, but there's something to be said about how you're raised, I think. Because
yeah.
what it is the comfort food, right? So like whenever something happens as an adult, your brain goes back to comfort food and whatever your parents, unfortunately, if it's fatty or if your mom took you to McDonald's every time you got a, award at school, that's you're gonna pull into that driveway when you feel bad.
Well, I ate a lot of cereal. That's probably why I was so reluctant to give up the granola,
Yeah.
because that was my last link to anything cereal like. I used to put it in milk. But I wouldn't feel good after I'd eat it. And all the keto cereals, I wouldn't feel good after I ate those. So it's just
H, I was thinking the same thing. He just like, I need food now. I was thinking the same
yes.
thing. I'm trying to avoid ordering some food right now. I mean, the dessert is on the way, but I'm hungry. Like I'm hungry, hungry. And by dessert, it wasn't nothing. I got a fruit cup thing with granola and whatever you call those things. Not a fruit cup. Is it called a granola cup? I don't even know what they call them.
Oh yeah, the one thing that would actually make me jealous. Thanks.
My
I'm just
bad.
kidding.
My bad.
It's weird though, because I have the memories of things, and it's almost like the memories are enough. It's like getting over the sugar craving. That's where the Quest cookie thing
Sugar's
came
the
in.
worst. Sugar's the
Because even
worst.
though it's low glycemic, it was very satisfying. Like you were eating, a sugary, cookie. And my mind tried so hard to trick me so many times. And even like 2 weeks in, and I'm like, you know what? I've done so good. I'm pretty much past it. I can have that cookie now. I'm like, wait a minute. What am I doing? Like your mind, that's where you really start to learn. Um,
I mean, that's when
just how
you
much
pass that
life
point though,
you
right? Like if you know you can have it and you still don't have it, then you're not restricting yourself anymore. You just don't want it. Like
right.
that's
I
when you know
mean,
you've gotten past that point of like you're not starving yourself or you're not keeping anything. You just got to the
it
I've
was
got to
a
that
month
point once when
before.
I was eating vegan where I stopped all my sugar, where I actually killed everything. I didn't crave sugar anymore.
That's hard to get to.
Yeah, but it wasn't. It's hard to sustain. Just the sugar and everything.
Yeah. Well, I mean, unless you make it a lifestyle, which I have. That cookie craving almost killed me. I mean, as hard as you can pout without crying, like
Mm.
as hard as you can pout, I was in that state for a good 3 weeks of that month. I just felt so deprived. But then one day I don't know, I think my birthday came. I had the perfect excuse because I've been planning on having like a Quest bar or a Quest cookie on my birthday. Like that was part of my original rules that I could. But then like I decided, no, I really don't want to do that. And then after that, like it was gone. It
H
was really fun.
H, you gotta realize, like over here, the food it's very easy to eat bad. Like what you consider eating bad over there is probably what the level most people are trying to get to that they'd consider eating healthy over here. Like those stereotypes of McDonald's every day, that's a real thing. Like that's a real archetype. That person exists. And it's not
Most people.
everybody. Yeah, it's not everybody, obviously, right? People, but it's enough people to where there's a McDonald's on every corner. Yeah, it's not so like what you consider eating bad is like decent eating for Americans, in my opinion. Unless you're eating at home every day. If you have a home cooked meal every day, then it's the same everywhere.
Us
But
American food is, I mean, a lot of the things are banned in other countries. It's really hard to find something that isn't legitimately extremely bad for you.
the fast food, yeah,
Well, even just like boxed foods and
the breads.
yeah.
McDonald's makes them classify the breads as dessert. Like it's in the dessert section, buns, because of the sugar content.
The French fries are a carcinogen, which is crazy. I mean, they legitimately are a carcinogen.
I think street food is probably way healthier than fast food. Even the health standards in some places are not great. Little hot dog cart isn't what I'm talking about when I mean fast food. I mean like somebody that's chopping up actual pieces of beef on a grill, on a stick for a skewer, you know what I mean?
Yeah, that probably is better.
Way better than McDonald's or Burger King or something like that. Yeah, because it probably is food age. Like the burgers over there are probably made of actual cows. The burgers here are all ground up bones, muscles, tendons, meat into like a paste, and then the paste is spit out onto the thing and it turns into a patty.
Well, that part's actually probably good for you. But
McDonald's.
I think the additives, and then I just found out that Taco Bell, one of the seasonings that they season their meat with is oats, and it's a lot of oats. So they pretty much use oats. It's better. There's not very much meat.
Yeah, it's also very bad graded meat. If you go inside a fast food, there's that big white thing that nobody reads. That's the health inspector thing. And they give a grade to the beef. Like when you go to the store, it's grade A, right? You want to try to buy the grade A. Taco Bell's grade F, the beef that they use in their soft tacos. It's like literally the last possible worst grade you can get before you can't give it to humans.
It was good though.
But yeah, and then there's a lot of filler and stuff too. Listen, I ate so much Taco Bell in my life. The high school I went to across the street was a Taco Bell, and we had open lunch, which means we could leave for lunch and come back. I used to take all three lunches: first lunch, second lunch, third lunch. We would just post up in front of Taco Bell, put all our money together, buy 1,000 soft tacos, and just chill for 3 hours and talk to
It
girls.
used to be inexpensive.
59-cent tacos, 39. I think during the summer it used to be like 29-cent tacos, 39-cent cheese tacos, or maybe less than that. No, I'm thinking about McDonald's. McDonald's used to have the 39-cent cheeseburgers and the 29-cent hamburgers. But you could buy like a 20-pack of tacos for nothing. Soft tacos, like almost nothing. So we get like 7 or 8 20-packs and just dump them out on the table. Feed the school.
Good old days.
Mm-hmm. Whopper is the superior um, of the fast food main burgers. You gotta admit, the Whopper is hands down between the Whopper and the Big Mac.
I liked the Whopper. That was my go-to.
Actually
With
looks
bacon.
like a piece of meat, you know? Is Trader still moving or not? Oh shit. I'm scared to look at this point. Oh wait, this is the wrong chart. Let me go to a YouTube chart. Hold on. Oh, where the hell did my charts go? Look at it poking up. Yeah. What's the other chart that I had with it though? Here. It doesn't matter. So, rescue ship or rocket ship? All right, price came down. Prices moved up from the lows. You had distribution, which creates. I almost got that completely straight. Fail. Order block. Right, order block there. I didn't even try on that one. So we're coming up through that, but the question is, right, is it a rocket ship? Meaning we didn't mean it, off and to the right? Or is it just mean recovery? So we go to our EMAs. Go to the daily. W50 on your 1 hour. You're going to be above most of your lower time frame EMAs. So mean reversion on what time frame? Right? We know after a drop like this, there has to be some sort of mean reversion. Not that you expect a regular price action if this has actually been rug pulled. But for me, I would really live on low time frames. Very low time frames. Why is my chart tripping? A second. There we go. You've already blown your shit out on the 5 minute. Double top, lower high. So goes without saying if you can't take out that high, right? This was the top. What were we saying? Somebody was trying to say something.
Oh, I was just hopped on here. I just saw it.
What up? What you been dealing with?
Nothing much. Just trying to catch up on the news.
Clarity bill, really, back and forth. Looks like the banks are gonna get the W on this in the long run, but I wasn't in the camp of thinking that banks are about to take an L anytime soon, so it's not really gonna make or break me one way or the other. Other than that, hasn't really been a lot going on at all.
The straight still closed.
Yeah. Iranians keep saying the same thing. We're going to keep controlling until we get what we want. The only one that keeps saying anything different is Trump, right? 1 week, we're super close to a plan. This is going to work. And the weekend comes, no plan. They better be lucky we don't bomb them. And then Tuesday comes around. It's looking good. Negotiations are looking great. The oil's flowing. Just Thursday, he said, the oil's flowing right now. When I look out in the sea, I see thousands of tankers just lined up, ready to deliver oil to. I don't even know. You listen because you got to listen, but it's like, you know? Like I listen to what the man says because he's the president, and I have to pay attention to what he says. But at this point, gang, like I'll go check the damn ship radar myself. You know.
I mean, I doubt he wants the gas prices to go much higher.
Nah, he said some crazy shit yesterday. He said the United States is selling more barrels of oil than we've ever sold. Everybody keeps complaining about. Everybody keeps complaining about high gas prices, but don't realize that like we sell gas. And I'm sitting here like, yeah, but you don't realize people fill up their gas tanks. Like people aren't, you know what I mean? That doesn't help nobody. Still paying $6, $7 a gallon.
Damn, I thought I was bad. I just paid $4.49.
I saw 701 yesterday for the first time premium. I didn't buy it, but I saw it. I didn't buy it. I drove by it, you know? Yeah, no, it wasn't yesterday. It was like 3 days ago. It's when we were
installed the 7-Eleven app, you can get a discount. It's crazy. I buy my gas on their app, and when I walk up to the pump, the price goes down on the machine, and the number changes.
Oh, dope! It's like a rewards thing.
I don't know. I think it's just
like a membership rewards thing for being a member or something.
I guess.
Or for having the app. Nah, just loyalty sort of thing. You got the app, so you get a discount sort of thing.
It's just amazing, like standing at the pump and you're looking at the prices.
Yeah.
You go on the app, you punch your pump number in, how much you want, and you're just looking right at the numbers that the prices just go down. I gotta shoot a video of it. It's crazy.
Look at Lab, you said. Looks like it would like to start doing a thing. Type 2 entry would be very interesting here, actually. Just structure-wise, I have no idea what this is. At all. You start from the beginning at the top of the list. Huh. See? You see why we back up? What looked like an amazing dip buy on the 5-minute looks like this on the weekly. You get how different that is? Again, weekly doesn't matter if you're playing short term, right? That doesn't mean there isn't a short term trade here. But there's a big difference between if this was the entire chart, right? To then going to the weekly and realizing, no, gang, this thing has been absolutely pumped. Yeah, they try to do these indices all the time. It just depends on how you balance them. You got to look at the smart contract. I'm waiting for a really good, smartly balanced index. But, I mean, that's boring. I'll do that shit when I'm like 60. All right, so, anyways, point being, I wouldn't if this thing just collapsed, there'd be zero surprise from me. But to keep this stopping volume candle alive, just on a regular sort of scalp trade, you're looking for a type 2 entry. Because what you had here was vector recovery. And this vector on the 15-minute already filled half of its. Well, give or take. But if it holds and you get some volume, then maybe you go after the full recovery on the top vector. Maybe. I don't like the way this chart looks. Right? We know that these things hold. Remember when we talked about our rotations, right? You rotate to that 200, price can hold for a while. That's a nice reaction, though. It really is. It's a lot of liquidity down here. Yeah, I don't know where your position is, but I'm almost hoping it's short. That's good. Oh, wait. Okay. Well, so you bought the big red candle? Oh. All right. I wish I could individually open the classrooms for each specific person. Because I would still have H trapped. Chapter 2. Chapter 2, Chapter 3. Yeah, but that's not the point. You can be on spot and okay and in profit, but could have taken a better entry as well, right? That stopping volume candle would have been a beautiful entry. You'd have been in at 65, 70, maybe the worst 72. I'm gonna get you there kicking and screaming. Watch. My Labubu short is still good. With good money. I was just looking at it earlier. I could have asked for a better reaction to re-entry than that. You notice how when coins are repricing on the other side of expansion, they tend to drop in the same patterns? Right? You could easily take this and overlay it with Bitcoin's top. Right, our first relief rally. Second release rally. God willing. That's our last pattern to fulfill the reason for being in this trade in the first place. Well, reason for being in this trade in the first place is that Labubu shit got really out of control. First of all, I know a bubble when I see a bubble. I didn't even have to look at the chart to know that this thing was in a bubble. But yeah, BTC is not doing anything, guys. Chill out. Whole lot of nada. Nah, chill. See, no, because that type of shit brings the troll out of me, and I try really hard to keep the troll locked away. I think I'm funny, but then people take shit serious, and then it gets weird. Nah, not currently. I mean, if the opportunity shows itself for a good asymmetric trade, I'll take it. But no, I'm currently trying to get this ES short kicking. I've already started layering in. This is probably the only trade I'm in right now that I won't say keeps me up at night, but is probably like the last thing I think about before I go to sleep. And that's just because timing, right? Directionally, I believe I'm fine, but timing, I'm playing with options anyway, so it doesn't matter. But so this is my current short. And I will be adding more contracts every day that we're underneath. Where is that? There it is. So sort of like the Labubu short, right? It was a good short that was interrupted. This move up here was the most bullish that the market's been since 1952. Yeah, like I'm opening way out of the money 3-month puts on ES. It can't be somebody knocking on my door this time, right? It's got to be like a cat on the roof or some shit. Nah, I've got it balanced. I'm layering in so slowly. I don't think it's gonna take that long. Famous last words. But when it comes to options, you have to take the unpopular. You have to take the unpopular trade to get the best price. You know what I mean? So unlike everything else, where I like to wait for a little bit of confirmation, I need to strike when my TA gives me the conviction. I just strike and then I make sure that I leave money to be able to weather the storm. I don't want any Michael Burry situations. Right? Not everybody has the funds, money to keep himself afloat. Speaking of, he just made 4 big trades that I can't say I completely disagree with. Damn, I just had them in my head too. Well, one, he's long GameStop. Good night, H. One, he's long GameStop, which we talked about the other day. He's short the Qs. It's not that Oracle has more effect than Nvidia, is that Oracle's Nvidia's biggest customer. So Oracle's the first sign that Nvidia is going to start seeing issues when it comes to earnings. The problem is that everybody knows that, right? So people will react to Oracle like if it was Nvidia. Like if Oracle misses earnings, they're going to react to it the same as if Nvidia would have missed earnings. Because everybody's looking for that sort of canary, that first crack, or that first sort of leak in the bubble. All right, give me a second, y'all. I gotta go check on Grandma Block. Make sure that she's got all her medicine. Her nurse just left a little while ago, but I'll be right back. Ladies, gentlemen, what's good, Joe? My dessert came, but then I had to do a quick workout because it's technically not cheat day again, and I felt guilty. Still in the weekend trap. Bearish channel is invalidated. Support is support until it's not. Resistance is resistance until it's not. Can move this up a little bit here. To that value area low. What's good with y'all? What are y'all up to? Grinding. Nice. Drive safe, Ian. That's good, bro. Investing in yourself. Weekend trap is like an old friend. It's like he's boring as shit, but you would miss him if he was gone. This W fell apart without hitting its measured move, huh? Or is it hiding? Not completely. Clean up the chart a little bit. I'm working on the final layout for the Cypher Intelligence Group reports. I think I basically got it nailed down. Decent little report, if I do say so myself. Don't ever bet against CZ, bro. In my opinion, if you can avoid it. If you don't want to trade it, don't trade it. But don't ever bet against them. It's the same for Tron. You don't hear about anybody in the US talk about Tron, but overseas, massive. You know, they get the majority of transactions under $1,000. I think I almost got this boiled down. I have a meeting with one of our first potential clients this week. So I'm trying to make sure to just get the presentation down. It's really all I'm looking at here.
What was the business again? I didn't hear it.
One of my buddies that, I mean, he's kind of got lost. He makes like 6 figures just working as a quant in one of these companies. He doesn't even really trade. Just buys Bitcoin and sits on it and makes his money at work and then sells. But he said that he has access to all of the APIs that his firm uses for research. Right, and they allow them, they allow the devs and the quants access so that they can use them inside of their AIs or whatever to connect, you know what I mean, to be able to do research. So he's like, I really want to put together like an analyst, group or like an intelligence group, basically do, excuse me, to basically do investment theses on different assets, right? So whether it's anything on the stock market, anything on, but on the institutional level, like these will be reports that get taken to boards, hopefully, inshallah. There's a ridiculous amount of money there. So the reason that the partnership works for me is because he's giving me access to the raw data. I let him know how it needs to be structured and put together to make any sort of sense, with any sort of like certainty. And we're going to try to shop it around for, there's going to be tons. My thesis is there's tons of institutional clients, smaller level, smaller houses, right, that are going to be getting involved in crypto outside of just Bitcoin during this run. And they hire out their analytics, right? Not everybody has quants in-house. So the market's kind of ripe for it. Crypto, there's not a lot. There's plenty for legacy, but there's not a lot of houses that do both. So we'll see. It's a little side thing I'm running.
it sounds. What is a quant? Okay, I don't even know what that is.
A quant is like, how do I explain what a quant is? um,
Well, good. Now I don't feel so bad. 'Cause I'm
no,
like,
no, no, it's not.
Google, what?
A quant, excuse me, is kind of like a super nerd, right? Like,
Oh, just a dressed up name for a nerd? That's what we're calling them now?
like as long as there's no quants here listening, yes. But no, what it is like it's quantitative trading, right? These are quantitative analysts. So it's literally all
Oh,
about
okay.
numbers, mathematical numbers, statistical analysis, computer algorithms. You know what I mean?
Yeah.
Anything that you
Okay,
can, yeah, anything that you can quantify. But the type of person that becomes a quant is like super high level nerd, you know?
gotcha.
Yeah. Like
You need to hook him up with Jacket.
but the thing is that they're great at crunching numbers, right? But you still need it's okay, what numbers do I crunch though? You know. So he's in a special position to have access to some APIs that would cost money, probably a lot of money. So it's just finding an edge, try to take advantage of it, right? Finding a need
Yeah,
and filling it.
it's
I was
really interesting. Boy,
surprised.
go ahead.
What happened?
Go ahead.
No, no, no. Go ahead. I cut you off.
I was going to say, it's really interesting the more I dig into the AI and these, um, just everything that you're doing with these agents and
Hmm.
development of all these. And it's so
I
fascinating,
told you, my zero human companies is gonna be the future.
just nuts.
Yeah.
That's exactly right. I mean, I was up half the night last night just going down one rabbit hole after the other after the other.
Well,
And I'm just talking to chat. And chat's like, oh, you want to go next level on this? Like you like to do? I'm like, well, yeah. So where, take down the rabbit holes. And
that's too funny.
gosh, it is,
Did you look into hooking up your store? Was that
it's
successful, or
funny.
I know it's a lot. It's a lot.
Yes. And it's not necessarily a store. Well, it kind of is on the side, but it was more for my son and what he's doing for his business because he's taken it all, this AI direction
Yeah.
and streamlining everything. And then he's going to have some
Mhm.
side thing, if you will, doing some merch. And yeah, all of I mean, anything that you can learn, I think it all is just going to help leverage, um, because one bleeds into the other, into the other, into the other. I
What's
mean,
really
like
amazing about it is what's amazing about it is it's not AI, right? Because AI can just put out a bunch of. If you go on YouTube and spend 3 hours scrolling through AI videos, you can see it's just a bunch of slop.
yes,
You can't even get through the whole video before being like, "Wait, what did they just say?"
yeah,
So it's there has to be a brain behind it, right? But if there's a creative behind it, it's like, oh man, like what can't you
yeah,
do?
that's exactly right. And that's my brain, and it's fascinating because it's not really his brain, it's the
Hmm.
creative side. But he latched onto it and saw with his type of business how it could change and how it could have an edge and how he could take um take his market basically. And I was like, wait a minute, you can do this with every company.
Yep.
And then you kind of you go 30,000 feet and go, no, wait a minute. This is about getting good, training these brains for them to run the company.
Yeah.
And then it's like, okay, this is a whole nother realm here we're
What's your
talking
idea
about.
as a boss, right? Your perfect idea as a boss is if you could hire a team
Hmm.
that would literally follow your directions. Like that's literally all you want, right? Just follow my
Exactly.
directions take care of each one of these issues the way it's supposed to be taken care of. And if there's something that you encounter that I haven't prepared you for, then you go ahead and you push that to me. I mean,
Yes.
that's something that
And
for a lot of jobs you can do without people.
well, and what it does is it what it's done for me is, and I'm scratching the surface on this, is it helps me think and process better. And the better I get at that, the more I can get out of my experience with just this entry level that I'm at right now.
Mm-hmm.
And chat was saying to me last night, it was like all of a sudden it just went, okay, you're doing some next level thinking. Your trading brain is moving in here and you're looking at systems and you're thinking in patterns. And this is further than most people ever get. They utilize us for what's the weather going to be tomorrow? Or who's the
Memes.
president in 1949? Yeah,
Yeah, yeah, yeah.
kind of thing. But the people that are really going to grasp this are the ones that are have the ability to do exactly what you just said, to see where you can take and build an entire company based on educating an agent to do a specific task, and then to question or like have three different agents that have a conversation between the three, come up with a solution, and then bring it back to you, and then move forward on the task. Just gosh, it blowing my mind of the facets that this is all taken on, and just never. I mean, I think I was a little, well, not a little. I was just intimidated by the whole thing initially, and now it's like I just can't get. I'm just consumed with it because I can see how far you can go with it. And I also see how much you've done with the school and things like that. And that's, not, I mean, that's deep level right there. I didn't realize it at first, but the more I get into
It's a
this,
lot
the
of
more
work.
yeah, it is.
People
It's like
think that
you can
they hear AI and they think that you just sit down at the computer and say, "Hey, make me something cool about uh
yep,
vector candles," and then just magic
yep,
happens. But
yep.
that's
And that's
not how it works at all.
yeah, that's exactly what chat was saying last night when it was saying to me on multiple occasions, this is further than most people ever get because they're doing exactly what you just said. Where you sit down at the computer and you say blah 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 and you're done. It's but the ones that actually are going to accelerate and advance, and I honestly I think it's going to be the have and the have nots. You're either going to grasp this and you're going to run with it,
Left
or you're
behind.
gonna there's gonna be a big chasm to the people that are
Yeah,
just keeping pace with hanging on, basically. I don't even think there's gonna be a middle part to this.
yeah, yeah.
Dang.
I agree.
Anyway, it's good stuff.
Some of
And
the
thank
dudes I know that are really, really deep, like they can't sleep. I'm not talking about like
oh
I trade. This is my thing, right?
good.
But people that AI is their thing, they literally can't sleep. Every
I
4 or 5 hours, there's a new advancement. Or my homeboy I was talking to, he was helping me out with this issue. He's like, bro, every hour that I sleep, somebody's getting past me. Like that's how he's thinking
I
right
can't
now.
believe you said that.
You
I
know.
told my son yesterday, I said, I already have FOMO so bad, and I'm not even doing anything. It's not like I have a job and I'm working and I'm doing. I said, it is crazy how fast I feel like I'm already so behind. And then chat reassures me like it did last night because it's going to glaze you and
Mhm.
says, okay, you're already for this much. And I think, in my age group, for lack of a better way of saying it, just in my sphere, inner circle, nobody's even, yeah.
Yeah. I
Most of them are
agree.
just retired and living it and watching their investments and doing things like
Same
that.
with same with my mom. My mom's still working, but I've got her using AI to sort her emails, and it's basically doing like maybe 40% of the job that she was doing. And it was an AI that was in her system already that they use at work, and just nobody ever taught them how to use it.
Yeah, yeah. I can't even imagine the companies that have this, that people have access to this and they have no idea. It's like I was saying, you're going to have people that grasp this and really understand how to execute the language, how to learn how to train an agent to do things, how to be able to give the correct prompts, how to think in the processes like they respond best to. And I mean, when I learned God mode and elite mode and things like that, when I first came across that, I was like, how did I not know this? I didn't even know there were prompts that you had to get, that you could get deeper level conversations with. You can get more expansive.
Yeah,
So
yeah,
I've got a whole sheet printed off of prompts that I asked chat, just again, just chat. We're not talking rock or
yeah.
any of the real deep stuff. I've got a whole list of that says, if you want me to do this kind of analysis, here it is. If you want me to do this for your trading, let's do this. If you want me to do this, because I'm taking care of my dad right now, or my parents, basically, their health with your caregiving, this kind of thing, and just all these different categories.
So
But
what an agent would do is you would have an agent that takes care of each one of those, right? So you would
exactly,
have one that you only talk to about your dad. You would have the other one that helps you with your business. You would have one that helps you with trading. And what that does is it helps them sort of focus, right? They
yes.
don't have all of that stuff in their head. Like they're very, when you talk to them, they know exactly what you want, right? They know why you're there. They remember your
And
last conversations.
let me tell you how invaluable this is going to be for people that really grasp. My dad just spent 4 days in the hospital because he was having some chest pains. We go to the doctor. At the doctor's office, he passes out. I have to call the ambulance, take him up there. I think it's the first time my dad's ever been in the hospital in his life. He's 90, healthy as a horse, and then he wasn't. I'm seeing these doctors, and my story. This isn't my first rodeo with um, taking care of people with health issues. I did my husband,
Yeah.
but they have it's. We're there for 4 days. They run every test under the sun. We're leaving, and like, you know, it's just, maybe he just needs to drink some more water. He just got a little dehydrated. And I'm like, well,
A lot of these
I'm
doctors are
thinking he's
full of
never been
shit.
on a prescription drug in his life, and now he's on 3. And every side effect I see him having right here are side effects of 2 of the drugs. No, 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 not the drugs. And I'm like, I'm not so sure. So this is not an agent, because here I am researching all day long, going down these rabbit holes of heart disease and all the statins and all the medications and all the
Hmm.
controversy. What this agent can do for me in minutes, instead of me spending an entire day just going down one medication side effects, and could it be the reason why he's having some challenges now? And that dedicated just solely to my dad, and training that agent and being able to understand how to give it commands to do exactly what I need to do for the research that I need for him, so that when we go to the doctor, I can take that information and not sound like I'm, Dr. Google, but I have statistics, I have things to back it up, but I'm letting the agent do it as opposed to myself, because I'm trying to handle 1,000 other things as well. That's where I'm just like, this is going to be unbelievable for the people that can actually take advantage of it.
Yeah. You
I
need to be
really
your
do.
own health advocate, unfortunately,
Oh, you have
especially the older that you get. My mom,
absolutely.
right? So my mom's crazy. She's a crazy woman. My mom, the last time she left the house, I'm trying to remember how old she was. 60, probably late 60s. Because it was a while ago. But yeah, no, oh my God, if she was to hear me right now, she would definitely, it was between like 65 and 69, probably like 67. Anyways, she went out with her homeboy, her best friend, right? Funny Cuban guy, super gay, like cartoonishly gay, like one of those.
Oh my God.
So they go out and they have a blast together and shit. So he calls me at 4 o'clock in the morning and he's like, "You need to come to the hospital."
Oh no.
I'm like, bro, what happened? And he goes, Your mom fell off the bar and she broke her ankle, right? Or
Oh
no.
my.
She fell off the bar. She fell off the bar and she broke her ankle, right? So I'm like, oh, she broke her ankle. I jumped in the car. I'm like 2 blocks away from my house, and I was like, wait, just registered. I was like, wait a minute, what is she doing on the bar? First of all, so then I got there, and she's like, hey, I guess I'm old. I'm like, what happened, Mom? She's like, well, I was dancing, and then this guy spun me around, and I spun too fast, and I twisted my ankle. I was like, you just gonna lie to me? You're just gonna lie to me in my face because he already told me you fell off the bar. She's like, okay, well, we were on the bar when it happened, but he did spin me, and that's she tried to. So, anyways, the doctor, right? They had to put a pin in her thing and a cast or whatever, healed.
Oh.
But then she's like, when I walk, it hurts, right? Like I feel it every time I take a step, even after heal. So we go to the doctor. I'm like, look, it's not fixed. And he goes, well, she's over 65.
Yep.
I'm like, bro, that's not how it works.
That's exactly right.
That's not how it works. She was fine before, right?
Yep.
You bring the car into the shop. The mechanic fixes the car back to we're not doing that. Oh, she's old. Things are supposed to hurt or, not just get used to the pain because you're old. That's bullshit. I guarantee you that super wealthy people do not deal with that type of bullshit,
You're exactly right. And if I said once, said 100 times to my mom, if I hear one more time, well, he's 90.
Yeah, nah, screw that.
80 at 89, he'd never been on a prescription drug in his life. He was out rolling 7 o'clock in the morning before we even got up, going to coffee with his bros. And I said, Dad, you know what? If I didn't know better, I think you'd have a girlfriend. I just come visit, I said, you're out all the time. I hardly even time he's out with, doing this, doing that. And then all of a sudden one day, again, he passes out and then he has 3 terminal illnesses in one initial meeting. I'm like, wait, what? What happened? So, and from that point, I'll bet you I've heard, well, he's 90, 500 times. And I said, 6 months ago, he was 89, and no one ever said that. Everyone said, oh my gosh, your dad's an anomaly. He's
Yeah.
going to outlive us.
Yeah. And then you just look like you're being irrational because it's your loved one.
Exactly.
Yeah.
Exactly.
Nah, I feel you.
It's the same exact thing. And yes, you can fix this. You just have to figure out what it is and not prescribe him something because he's
Exactly.
not going to take it unless he has to.
Nah, they'd rather
Unless you
put
say,
you on pain pills for the rest of your life.
oh, let me tell you, that's exactly right. And getting that straight with doctors right out the gate is imperative that no, this isn't going to be a script and or going on down the road. But
Christian, what's going on, bro? But yeah, nah, I mean, definitely. Like, there's just no, if they fix it, that's it, right? Like, if you pay for it and they fix it, then they can't, there's no follow up charge. There's no, But monthly
Well,
prescription
mom,
to some pills and some. Nah, took her ass to the gym. To the gym, she built up her strength. They looked at her leg. They said that some metal was touching where it wasn't supposed to be touching. So they said that she could either go and do another operation or she could stay going to the gym and see if her muscle, if she
yeah,
builds up her muscle around the area, would be unnecessary. But it's not, it's not the 40s. Like, there's really zero. And I'm not talking about just eat pain pills. What I'm saying is, like, there's no reason to live with pain. We have the technology. It's just
that's
that I think
right.
her generation is used to living with some sort of baseline of pain, so they just don't complain about shit.
Well, they're used to being under the impression that doctors are gods and you
Mhm.
do what they say regardless. And I'm still dealing that with my mom is, you bow down to the system and you open your mouth and take the pills as they say and you don't question them. And I said, if we can't get dad situated through the system that you're all caught up in, then we're going off script here and we're going to start doing things like bioregulators and peptides and things that I've done for a decade that have kept me out of that system. And for people like your mom who are in my age group, they're game changers. They're because all it is all chain amino acids and they're rebuilding and remodeling your ankles and your organs
Well,
just back to their natural state.
yeah, I tell my
Instead
mom all the time, just focus on sticking around. Your job is to focus on staying here, and then
yeah.
let technology catch up and take care of the
Oh,
rest. You know,
it is. It is. It's just locating it. Uh,
and staying
okay, let me
healthy
go.
enough to take advantage, right? Because
If the one thing you have your mom doing that's right is build muscle.
you know,
Build muscle, build muscle, build muscle. That is the key to longevity, my opinion.
I agree.
The strength element of it is because once you start losing that, and I'm seeing that in my dad just in the last 2 years, once that starts declining, it's a slippery slope.
Yeah,
And
grip,
and you can't build it when you're older as quickly. Her
grip
age and my age
strength.
are
Grip
right now.
strength is
Yep.
super important, and your quads. Right, the size of your thigh muscle, they say, is like a big marker for all course mortality. It like reduces your all cause mortality by a massive percentage.
Possibility. Yeah.
It's just good for blood flow. It means your circulation is good. It means you're more likely to be able to balance yourself and not fall and
Well,
break a hip. You know, your grip
that's
strength
exactly
keeps you
right.
from falling. And
The notion right now is that older people aren't falling and breaking their hips are breaking and they're falling
mm, mm-hmm,
is happening because their bones are so brittle. And
nah,
again, their skeletal muscle is not supporting them enough. But back in the day, us growing up, building muscle, no, that was for bros. You don't do that. It's not feminine. So it's a mindset difference too. And
Chad's
you
laughing. Nah, I'm dead ass serious, man. Guys, chill with the freaking biceps and the push ups and go work on your quads. It's good for your testosterone too. Get those squats in.
God, no doubt. That's another biggie. Okay, I'm gonna try to get back to sleep.
Good night.
Keep doing good job with the school though and all you're doing. And
Appreciate you. Class tomorrow, by the way.
yep, it is.
It's not
Mhm.
it's not gonna be a big rush. I'm gonna go over what I went over today. So if
Yeah,
you were
I
here
just got
today,
part
it'll
of
just be a chill day.
I just caught part of it, so I'm anxious to go over it again because
All right, cool.
it was fascinating. That was good stuff. Some stuff that I had known, years ago, just a handful of years ago, but that made me rethink about things again because I'm trying to talk to one of my family members who's asking me questions about Bitcoin. And it's just like you said, well, you didn't say this, but I thought this. You should have put this earlier in the class. And I thought, yeah, when you're in college, it's hard to go back to kindergarten.
Yeah, yeah, yeah.
And that's what I feel like I'm doing, trying to explain to him on a kindergarten level, and I haven't thought on a kindergarten level with Bitcoin in a long time. So
It's
it's
hard.
those
It's
little
good to
bitty
go back
things.
to first principles, though. But yeah, it's
Yep,
hard to do.
that's exactly right. All right. Night.
Take it easy. You were here earlier, though, right, Sample? You're not gonna miss much. That took a long time to get through, so that's probably gonna take the whole class, honestly. But with as much as everybody's talking about the Clarity Act here coming up, I think the stablecoin part is important to talk about. All right, I think that Bottom of the box, top of the box. These words are annoying me. Yeah, sure, no problem. Problem with dealing with some of these quants is that they don't understand what it takes to do certain shit because their brain is so focused on one. Like, hey, then we can write up a skill set to include commodities. It shouldn't be that different, right? Shouldn't be that different. No problem, bro. I'll just rewrite the algo from the ground up. Like using a binocular, like a pair of binoculars to see where the fish are at. That is a job for tomorrow. You ever decide to partner with anybody? Don't do it with anybody on the West Coast if you live on the East Coast because it will keep you up all night. The people, it's getting late. What time is it? 5 hours in. I can restart in the morning.
This was a strange weekend wrap, from my opinion. Also, CME opens in an hour. Bitcoin, come on, man. What a bullshit. This is why I hate trading on weekends. Stupid weekend trap.